Ladies and gentlemen, welcome to the second day of the Baker Annual Conference on Domestic Challenges at the End of the Century. We had an outstanding day of presentations and debate and dialogue yesterday on urban crime and violence, the whole issue of the devolution of governance, superb presentations by Jack Kemp on tax policy, and of course by the Attorney General Janet Reno on urban crime and violence. Today we are going to address the critical issue, and I say that with due deliberation, of tax policy and the possibilities and options of tax policy reforms. I think what we saw yesterday in the deliberations was very telling, is the interconnectivity of all these issues. The issues of urban crime and violence, of our inner cities, of welfare, the devolution of governance, the challenges posed to the governors and mayors of this country to provide for the daily livelihood of our citizens, all comes back to what we are going to be discussing at this panel today, tax policy, which really is a key determinant of economic growth and the creation of job opportunities. I would like to announce that unfortunately the Deputy Secretary of Treasury, Larry Summers, as I announced yesterday, is unable to be with us today because President Clinton has called for budget meetings this week and he had to stay in Washington. Our panel will be chaired by George Zodro, who is a professor and chair of the Department of Economics at Rice University. He was a staff economist at the U.S. Treasury Office of Tax Analysis in 1984-1985, participating in the preparation of Treasury One, the study that was the precursor of the Tax Reform Act of 1986. He also served as a consultant on tax reform issues to the World Bank and the Agency for International Development, and has been involved in taxation projects in many countries. In fact, he is leading a study we're doing at the Baker Institute with Professor Moskowski on the consumption tax. His articles on taxation have appeared in numerous publications, and he is a member of the editorial advisory board of the National Tax Journal. I introduce George Zodro, who will announce our panelists.
Thank you very much, Ed. It's certainly a pleasure to see all of you here today. I believe we have an outstanding program for you this morning, a fitting conclusion to what I hope you will agree has been a highly stimulating and informative conference on domestic policy challenges as we approach the end of the century. As you know, tax reform is certainly a hot topic today, although perhaps not quite as hot as it might have been had our speaker yesterday morning been Vice President-elect Jack Kemp. Nevertheless, there is still a great deal of interest in what is often referred to as fundamental tax reform, although more modest changes are also often discussed as well. The fundamental nature of the proposals that are the focus of this conference arises because they would not simply make incremental changes in the existing tax structure. Rather, they would, in the words of Texas Representative and House Ways and Means Committee Chair Bill Archer, rip the income tax out by its roots and replace it with a consumption-based system that would, in one form or another, and in marked contrast to an income tax, eliminate much of the taxation of the return to saving. This critical feature, tax exemption of future capital income, characterizes a wide variety of current reform proposals, including the national retail sales tax that's promoted by Congressman Archer and Senator Lugar, the Army-Shelby flat tax proposal, the unlimited savings allowance, or USA tax, that's been proposed by Senators Nunn and Domenici, and the national value-added tax that has been championed by Representative Gibbons. The interest in consumption tax reforms arises primarily because many observers, including a wide variety of academic and business economists, believe that taxation on the basis of consumption is inherently superior to taxation on the basis of income for a number of reasons. It is this basic contention which is, of course, critical to an evaluation of all the reform proposals just mentioned that will be addressed by our panel today. And I think it is a very distinguished panel indeed. Starting from your right, our first speaker will be Professor Lawrence J. Kotlikoff of Boston University. Professor Kotlikoff has served as a senior economist with the President's Council on Economic Advisors, as a consultant to the Joint Committee on Taxation, the World Bank, the International Monetary Fund, and a wide variety of governments and private corporations around the world. He has published extensively in professional journals, as well as many articles in the popular press on a host of critical policy issues, including taxation, Social Security reform, deficit finance, pensions, saving, insurance, and a very innovative alternative method of measuring the redistributive effects of fiscal policies across generations. He and Professor Alan Auerbach of Berkeley have constructed a dynamic economic model that is now widely used to analyze the effects of tax reforms. Professor Kotlikoff is going to present the case for taxation on the basis of consumption and will also report on the effects of implementing a consumption-based tax as estimated by his simulation model. Our second speaker is Dr. Eric J. Toder, who is currently Deputy Assistant Secretary for Tax Analysis in the Department of the Treasury. Dr. Toder has served in numerous other positions in the Treasury's Office of Tax Analysis and as Deputy Assistant Director for Tax Analysis at the Congressional Budget Office, as Director of the Office of Finance and Tax Analysis in the Department of Energy. Dr. Toder has also managed to find time to contribute to the academic literature on tax policy and has published articles on a wide variety of topics, including the tax treatment of capital gains, the effects of taxation on portfolio allocation, and a topic close to the hearts of many in the audience, energy taxation. Dr. Toder will present his perspective on the relative desirability of consumption tax reform and also report the results of some Treasury analysis of the distributional effects of such reforms. Our third speaker is Dr. Charles E. McClure, Jr., who is Senior Fellow at the Hoover Institution at Stanford University. Dr. McClure served as Deputy Assistant Secretary for Tax Analysis in the Treasury under then Secretary of the Treasury James A. Baker III. He was responsible for the preparation of the 1984 tax reform proposal known as Treasury 1 that was the precursor to the Tax Reform Act of 1986, generally believed to be the most wide-sweeping reform of the income tax since its inception. He has also served as the Director of the Treasury's Working Group on Worldwide Unitary Taxation and as Vice President of the National Bureau of Economic Research. Dr. McClure has directed or participated in a host of tax reform projects around the world and has published widely on federal tax reform, the value-added tax, double taxation of dividends, state corporate income taxes, and taxation in developing countries. He's also well known at Rice, as he was the Klein Professor of Economics here in the late 60s and early 70s, not to mention the fact that over the years he has collaborated on a number of research and tax reform projects with none other than our own President, Malcolm Gillis. Dr. McClure is going to discuss some of the administrative and compliance aspects of a switch to consumption-based taxation. Finally, we're fortunate to have on our panel Dr. Rudolph G. Penner, who will discuss all three of our papers and offer his own perspective on the desirability of fundamental tax reform. Dr. Penner is Managing Director of the Barron's Group of KPMG Peat Marwick in Washington and has thus been responsible for the implementation of tax reform projects around the world. He has served as the Director of the Congressional Budget Office, the Assistant Director for Economic Policy at OMB, Deputy Assistant Secretary for Economic Affairs at the Department of Housing and Urban Development, and as Senior Staff Economist on the President's Council of Economic Advisors. Dr. Penner has also been a Senior Fellow at the Urban Institute and a Resident Scholar at the American Enterprise Institute. He's published numerous books and articles on taxation and is particularly well qualified to comment on the relative advantages and disadvantages of consumption taxation, as he is one of the primary architects of the non-Domenici USA tax. Before we begin, let me mention a few organizational details. Each of the three paper presenters will have about 30 minutes to summarize their papers, after which we'll take a short 15-minute break. After that break, Dr. Penner will present his formal comments on the three papers. We'll then have about 10 or 15 minutes for panel discussion and a similar amount of time for questions from the floor. As in the previous two sessions of the conference, those of you who wish to pose a question to any member of the panel should write it on the index cards that have been distributed. Raise your hand and an usher will collect it from you. Please note if the question is to be addressed to a specific panel member. So without any further ado, let us begin with Professor Kotlikoff, who will discuss the economic impact of consumption taxation. Professor Kotlikoff.
Thank you, George. It's a great honor to be here. George Will has described our era as an era without heroes, and just like to say that Secretary Baker is one of my heroes, and I think he's a hero of millions of Americans he's never met. So I'm particularly honored to be here with him today at the Baker Institute. Let me try and provide a little perspective for discussing consumption taxation. We in our country face two interrelated crises. One has to do with the macroeconomy, the fact that we have a very low saving rate, a very low investment rate, quite low growth rate, and the other has to do with fiscal policy, the fact that our fiscal trajectory is very grave. If you look at the long-term projections of Social Security, Medicare, if you look at the demographics, if you look at the official debt that needs to be, interest on which needs to be paid, if you factor all these things in together, it really is quite frightening, as I'll describe in more detail shortly. These two crises are interrelated, as I'll mention, and the consumption taxation is one of several critical policy decisions or choices that we have that can help us get out of the hole that we're in. We have, in my view, spent about 5 decades digging this hole, and it may take us 5 decades to dig our way out. But we have to begin, and the sooner we begin, the better. And we need to do it with sensible policies that don't get us into worse shape. I think consumption taxation is one of those very important, sensible policies that it's time for us to adopt. Now, let's talk for a moment about what's happened to U.S. saving and the macroeconomy. The saving rate in our country, if you measured in terms of the saving out of net national product, our output after we factor in the depreciation of our capital stock, our saving rate is roughly about a third of what it was in the 50s and 60s. Our investment rate, domestic rate of investment, of net investment, is similarly about a third of what it was in the 50s and 60s. Our growth rate of output, of GDP, real GDP, is about 2/3 what it was in the 50s and 60s. Our growth rate of output per person, per capita output, is about 2/3 of what it was. Our growth rate in labor productivity, output per worker, is about half of what it was. Our growth rate of real wages, the real wage rate, the hourly wage rate, is about a third of what it was. So our economy has been going downhill. And at the same time, if we look into the future at all the obligations under Social Security, Medicare, and so forth, things don't look too good in the future. It's not like we've had a bad time and things are likely to get better. Rather, if you look at the trustees' report of the Social Security Administration, you find that the long-term 75-year deficit in Social Security as a percent of taxable payroll is larger than prior to the Greenspan Commission back in 1983. In other words, we have a bigger long-term crisis with Social Security by itself than prior to the Greenspan Commission, notwithstanding the fact that Senator Dole told us that he had helped save the system. Well, the system's in worse shape than before he saved it. The Medicare, the projections, and I think they're overly optimistic, as are the Social Security projections, because historically they've always turned out to be overly optimistic, are for the Medicare system to start eating up bigger and bigger chunks of the economy, rising to about 8% of GDP from about 2 to 3% right now. Now, if you factor all this together in something which I call generational accounting, which is to look at how this is going to impact on our kids and the next generation of kids, and you ask, what does this imply? Well, it implies that if we don't get anything more out of current generations in terms of higher taxes or give them less in the terms of transfer payments, we're going to leave a bill for future generations which represents about 84% of every dollar they're scheduled to earn. That sounds like a crazy number. And I wish I could tell you that that number is calculated based on my own projections of the future, my own projections of what Social Security is going to pay and pay out, and my own demographic projections, my own Medicare, Medicaid projections, my own government spending projections. But in fact, these calculations are based on the government's own numbers and the government's own intermediate forecasts, and they're extremely troubling. Another way of describing the mess that we're in is to ask yourself, if you project all the spending under the Republican budget that was turned down last fall by the president, but suppose that we had passed that budget, and of course that budget didn't really get control of Medicare and Medicaid spending, even through 2002, but so suppose you assume that budget was passed today, and that after 2002, Medicare and Medicaid spending would be stabilized relative to the economy. And you think about that whole stream of spending on all government purchases as well as transfer payments, and you ask, how big is that in present value? And you add to that the government's official debt. And then you ask, let's think of this, so that's the bills that the government has to cover, and then you ask, what's the present value of the taxes we're going to be getting from current and future generations to cover those bills? Well, if you do that calculation, you find out that the present value of the taxes falls far short of the bills. Then you ask yourself the question, what if we had an immediate and permanent hike in federal income tax rates and federal income tax revenues? How much would it have to be to cover those bills? It turns out that you need a 50% immediate and permanent hike in federal income tax revenues in order to cover these bills. And if you wait for 10 years, it's 60%. Again, these are based on, in this case, the CBO's projections of all these fiscal variables. So we have we have two crises that are interrelated, and could well get worse unless we do something dramatic and very quickly. The decline in U.S. saving is really the result of our fiscal policy, which is generating this crisis. The decline in U.S. saving can be traced to the ever-expanding consumption of the elderly relative to younger generations, and certainly relative to future generations. If you look at why the U.S. saving rate has declined, your attention is drawn to the question, whose consumption has gone up? In other words, if our saving rate has gone down, our consumption rate has gone up. So then you say, well, whose consumption has gone up? Is it the consumption of the government sector? If you look at the government spending as a share of output, government consumption as a share of output, it's lower than it has been since 1950. So it's really the household sector whose consumption has gone up. And if you look within the household sector at who's consuming so much more, it's the older generations. On a per-person basis, the consumption of a typical 70-year-old relative to a 30-year-old has doubled since 1960. So what we've been doing is taking more and more income from young savers and giving it to old spenders. We have to realize that younger people are not the big spenders in society. It's really the elderly collectively. And this is quite natural. This is really what our economic theory tells us should occur. If you're closer to the end of your life and you have $1, you have fewer years over which to spend it. So your propensity to consume is going to be high. If you're younger, your propensity to consume is lower. If you're not yet around, if you're not yet born, your propensity to consume right now is 0. So if we do something in our government policy that lets current generations, particularly the elderly, have more dollars and takes it away from young people, and also takes it away from future generations, because when they show up, they're going to have a bigger bill to pay, then what we're doing is encouraging consumption. We're transferring from savers to spenders, and that's really the bottom line for why our national saving rate has gone down the tubes. And that's why our investment rate has gone down the tubes, because our saving is financing our investment, and our investment, of course, is the accumulation of physical capital, plant and equipment. And so since we're not investing at a very high rate, our labor productivity growth rate is lower than it would otherwise be, and that's why our real wage growth rate is lower than it would otherwise be. So there's a direct relationship between our fiscal policy of taking from young and future generations and giving to older people, and the fact that our saving rate has gone down the tubes and the rest of the economy with it. And that the fact that our macroeconomy hasn't done well has itself affected our fiscal policy. You know, it makes the tax base smaller if you're not growing as rapidly. So that's why these issues are interrelated. And as I speak, we have an ongoing policy of making these transfers from young to old grow ever faster. Medicare per capita benefits this year are likely to grow about 7% in real terms. They grew about 7.5% in real terms last year. That's an enormous bonus to the elderly generation, as well as to those who are close to retirement, as well as even to the baby boom generation. Because when I hit age 65, what the government has really done just in 1 year in letting Medicare grow at an excessively high rate is to promise me, myself, 7.5% higher real benefits every year from age 65 onward. So there's an enormous growth in the unfunded liability, in this implicit deficit. There's an enormous implicit deficit associated with the policies that we're running. And because of the way we're measuring our fiscal policy and looking at the deficit, the official deficit, which doesn't capture all these implicit liabilities, we're missing the forest for the trees. The President says we need to have a balanced budget amendment now. I mean, he's at least hinting that we need, or he's going to go ahead with or agree to accept a balanced budget amendment. And that may get passed, but what we really need is a generational balance amendment, something that protects our kids. Because basically the damage to the economy has been done under the guise of a balanced budget. We had, in Eisenhower in the 50s, and Kennedy and Johnson in the 60s, and Nixon in the 70s, Carter in the 80s, and the late 70s, Reagan in the 80s. Under all these administrations, we've expanded these pay-as-you-go programs, taking from young savers, giving to old spenders, and we've just used the language in terms of our official record keeping to avoid describing these as deficit policies. Were we to take the money for payroll taxes from young people that we give to old people and call that borrowing, and call the benefits we give them back in old age a return of principal plus interest on that borrowing, we would have about 3 times the amount of official debt on the books right now than we're actually talking about. So what we need is a generational balance amendment. Now, how does this has kind of been a digression, but it gets us back to consumption taxation, because consumption taxation is really a possible way of trying to reverse this process to some extent. Consumption taxation would put a somewhat larger burden on the older generations and relieve some of the burden of taxation on younger people. And that's primarily why in the economic simulation models that we have, and what are called neoclassical simulation models, or neoclassical models, that consumption taxation turns out to have a real kicker with respect to raising saving and investment and growth. There's also some good incentive aspects of consumption taxation, because you're not taxing capital income. You're getting rid of an income tax, which is taxing wage income and capital income. And when you tax capital income, you're really giving people an incentive to consume now relative to tomorrow, because what you're saying is that if you take your wages that you earn and you save them, then in the future you're going to have to pay taxes on the income that you earn on that saving. And that leads people to have less of an incentive to save for tomorrow, for tomorrow's consumption than would otherwise be the case. So the income effects, or the redistribution effects of consumption taxation, as well as the incentive effects, combine to lead to more saving out of output and more long-term economic prosperity. Now, there are different ways that we can. Let me just point out something about consumption taxation that economists talk about all the time, but somehow has not made its way into the public debate, which is we think about consumption taxation as a tax on wages plus a tax on wealth, a one-time tax on wealth. How do you think about that? Well, suppose that you start with somebody who's 20 and you confront him with a wage tax over his lifetime. So you understand how that would work. Now suppose you confront that person not with a wage tax or an income tax, but with a consumption tax. Well, he's going to earn his wages, but when he goes to spend those wages on consumption, he'll pay taxes. So in effect, you're taxing his wages if you tax his consumption, because his wages are going to be spent on consumption. Let's assume that he's going to spend his wages over his lifetime. Now take somebody who's has not just wages, not just labor income, but also some initial wealth. Let's take somebody who's 50, who's got a pile of wealth plus some additional future labor income. If you tax consumption, you're in effect taxing the person's wages, but you're also taxing his wealth, his principal, because when he goes to spend his wealth, he's going to pay taxes. So consumption taxation is structurally equivalent, mathematically equivalent to a one-time wage tax plus an ongoing wage tax plus a one-time wealth tax. If we had Jack Kemp standing up here saying that he was advocating a one-time wealth tax plus a wage tax, some of his Republican supporters would start getting a little bit uneasy, and some of the Democratic opponents would be their ears would perk up. That's effectively what is being advocated with a consumption tax. It's a one-time wealth tax plus a wage tax. And if you take the top 30 public finance economists, I'm not going to include myself in that group, but if you take them and you sit them down in a room and you ask them to raise their hand if they agree with that characterization, they will all raise their hand because that's the way it works mathematically. You can't argue with the math. Now, the elderly have a bigger share of the wealth in society than do the young. So when you go from basically taxing wages under, our income taxes wages and capital income, but the biggest part of the base is wage income. So when you go from an income tax to a consumption tax, you're taxing, in effect, wages at a lower rate because you're going to get some of the taxes now out of this one-time wealth tax. And the elderly are the holders of wealth, so that's how you get at the elderly. And because they have these higher propensities to consume, that's how you get their consumption to come down and allow total consumption to come down with it and national saving to go up. Now, there are different ways to tax consumption. We can do it directly with a retail sales tax. We could use a value-added tax. We could use a flat tax, which is essentially a value-added tax with a wage deduction. We could use a personal consumption tax. And the interesting thing to me is that the proponents of these different forms of taxation, those who, for example, if you talk to Dick Armey about the flat tax, or if you talk to Bill Archer about the retail sales tax, they don't like the other ways to tax consumption. Indeed, they don't think that the other ways of taxing consumption have anything to do with what they're advocating. But to economists, these things are essentially identical. So what I see is that the advocates of tax reform are in large part arguing at odds when they should be unifying together to go for any form of consumption taxation, because I think any form of consumption taxation would be an improvement over what we have. And economically speaking, you're going to end up with the same result if you tax it one way or the other. It's just an issue of taxing consumption directly or indirectly, but in terms of the economics, it's the same result. I'm reminded of when I went to testify to Jack Kemp's commission on tax reform. They came up to Boston, and they'd been working for a couple months. And there were about 18 commissioners, very prestigious, distinguished people on this commission. And I started going through describing how a flat tax was an implicit tax on consumption, an indirect way of taxing consumption. I said, look, a flat tax taxes wage income at the individual level. It taxes capital income at the business level, so it's taxing income in total in society, but it's allowing companies to deduct their investment. So you're taxing income minus investment. Investment equals saving, as we all learn in introductory economics. So you're taxing income minus saving, which is equal to consumption. Voila, you're taxing consumption, you're taxing it indirectly. And Ted Forsman, who's a major league investment banker and corporate raider who's on this panel said, hold everything. This is the first time I've understood that a flat tax is a consumption tax. Thank you very much. Now, I was happy to have helped educate him, but the question arose to me, why is that we have 18 distinguished Americans who know nothing about the economics of public finance or consumption taxation serving on this panel? Why is it that they are going to tell us what kind of a tax structure we need to have? I say this because I think that we need to elevate the level of the discussion if we're actually going to achieve anything, because the level of the debate is very low in my view. We have a lot of people saying things that just don't connect with respect to economic theory or knowledge. And this also comes up when you think about the issue of the regressivity or the purported regressivity of the consumption tax. How to think about it right. It's been purported that a consumption tax is regressive, but I think that if you think about it correctly, a consumption tax is not really regressive. It's a flat rate consumption tax would be proportional if we think about the way we should, the tax base at which we should think about measuring this. Think about somebody who's, people being young and old, think about them working when they're young, earning wages, and when they're old, they consume those wages. So let's assume that people earn when they're young and consume nothing, and when they're old, they don't work and they consume everything. Now suppose you had and let's assume that there's no capital income, so that when you're old, you just take the wages you earned when you're young and you consume them. Now suppose that we have a consumption tax, and we see that old people who are doing the consuming would be paying the taxes, because young people would be earning the income, and they would be paying no taxes because they're not doing any consumption. That would be described as regressive if you measured tax regressivity or progressivity relative to income, because you have the people who are young earning income or wages paying no taxes. The ones who've got the positive income are paying no taxes. The ones who've got zero income, the old people, who are just eating the wages that they accumulated when they're young, that they saved up when they're young, they would be paying taxes. So if you measured progressivity relative to income, the whole system would look very regressive. On the other hand, the society I'm describing here, this hypothetical society, is one in which everybody's identical in a cohort and they're all being treated identically. Let's assume that everybody is young, they earn exactly the same amount of money, and then they take that money into old age and consume it. And everybody would face exactly the same tax treatment over their lifetime. So the lifetime tax treatment would be identical. If you measured regressivity or progressivity relative to consumption, to lifetime consumption, a flat rate consumption tax would look proportional. If you measure it relative to current income, it looks regressive. I think we need to change our perspectives and think about progressivity issues the way economists do, which is on a lifetime tax basis, a lifetime income basis, or lifetime consumption basis. And from that perspective, a consumption tax looks a lot more, let's say, progressive than from a current income perspective. So again, if we could think about it this way, I think those who are Republicans who are advocating consumption taxation may be less for it, and those Democrats who are advocating or opposed to it and calling it regressive would be more for it. I think it's a large part a function of the way we're discussing it and the language we're using to discuss it. Now, let me say a few words about what simulation studies have shown that consumption taxation can do for the economy, and these studies also look at the lifetime progressivity or regressivity of consumption taxation. Together with Alan Auerbach, who's a professor of economics at University of California at Berkeley, I've developed it's called a life cycle simulation model. It's basically a simulation model that we built on a computer where people live for a realistic number of years, from like as adults from age 20 to age 75. And you have them making decisions about how much to consume when young and how much to save and how much to work. So you have all these kind of choices that we think households make. And we also have a government sector which is deciding how much to spend and raising taxes to pay for that spending. And we also have a Social Security system built in the model and some other features to try and make the model as realistic as possible. And we can simulate this model on the computer and say, what if you change the tax structure? How will the economy work its way out over the next 100 years? And the nice feature of this is that the model does its calculations assuming the agents making sure that the agents in the model correctly foresee the future. So it's not like people are fooled about what's coming in the future. They can foresee all the economic variables. So it's a very rational model. It's one which has, in effect, rational expectations for which Bob Lucas of Chicago won the Nobel Prize last year for developing that important line of economic theory. Now, these simulation models results, and other economists have built similar models and confirm these kinds of findings, they suggest some very major long-run effects of going to consumption tax. In the most recent runs that we're doing in conjunction with economists now at the Congressional Budget Office that we just completed in the last couple of days, actually, because what we've been doing is trying to improve the model through time and make it a little more and more realistic, add additional features. Well, what you find is that the long-run increase in the capital stock is about 50% from going to consumption taxation. The long-run increase in labor supply is about 6%. Long-run increase in output per capita is about 15%. The long-run increase in the real wage is about 10%. The long-run decline in the real interest rate is about 20%. Now, these are not, absolutely enormous improvements in the economy. Having output per capita output be 15% or so higher in the long run is not like having it 50% higher. But I'll take 15% higher. I think that we need to take every opportunity to improve our long-run condition in the economy that we can. It will take a while for the economy to transit to that improved situation. The simulation models show that it takes a long time to dig yourself into a hole, and it takes a long time to dig your way out. But you certainly can do it with consumption taxation. It certainly would stimulate the economy, and it would also be more progressive than most people think, especially if you combine, let's say, a retail sales tax, as many I think of in this room are advocating. The Americans for Fair Taxation is a group that has sponsored some of the research recently that I've been working on. And they're talking about having a retail sales tax plus a demo grant, which would provide additional progressivity. If you combine those two elements, what you find is that this is a policy that would help all income classes, all lifetime income classes in the long run quite a lot, and that it's not the regressive policy that many people have made it out to be in any way, shape, or form. So I think we need to think very seriously about consumption taxation. We need to do it from the understanding that our problems really relate to taking from young savers, giving to old spenders. We need to reverse that process. That's what consumption taxation would do. And it would be generationally more equitable than not making that move. And that we also need to understand that there's a lot of distortions in the current system, which I don't have time to go into, but there's at least 10 major distortions under the current income tax that need to be addressed in any way, in any case, and they could all be taken care of with a major consumption tax reform. So thank you very much, and again, I'm honored to be here. Thank you.
you very much, Larry. Our next paper will be presented by Dr. Toder, who will discuss distributional effects of recent tax reform proposals. Dr. Toder.
I'm very pleased to be here. I want to thank George Zojo for his kind introduction into the Baker Institute for holding this very valuable conference. The subject of taxation is always one of the most sensitive points of contacts between citizens and the government, and I think it's always valuable for us to re-examine the basis on which taxes are assessed and how tax burdens are allocated among the population. You will probably discern from my talk that I am not an enthusiast for all the consumption tax proposals out there, but I do want to say on a positive note that it's very, very valuable for the country that these proposals have been brought up and are being discussed, and that in the process of discussing these proposals, the end result will be that our tax system will be better, and that we will, if we focus on the flaws in our current system, we will raise the chances for some real improvements. The past several years has shown more interest in fundamental tax reform than at any time since the 1980s. That earlier discussion ultimately led to the Tax Reform Act of 1986, in which Dr. McClure and Secretary Baker played such an important role. That Reform Act broadened the individual and corporate income tax bases, lowered the top marginal individual and corporate rates substantially, and I believe, on balance, led to an improvement in our tax system and an improvement in our economy. Current proposals, like the 1986 reform, also seek to simplify the tax law and finance lower marginal tax rates by eliminating many tax preferences. However, there are some very big differences between the proposals that have become popular, most of them in the past 2 years, and what was happening in 1986. First, instead of reforming the income tax, many of the proposals under discussion today would eliminate the income tax entirely and replace it with some form of consumption tax. I'll get to what that means in a minute. Second, in the 1986 debate, the effort made by the Congress and the administration was to design a reform which would maintain the tax revenues of the current system and maintain roughly the distribution of tax burdens among income groups. In contrast, many of the current proposals would substantially reduce taxes on upper income families, and that would result either in bigger deficits or a smaller government sector, which serves the interests of some proponents of reforms, or it would lead, if we do have to maintain revenue, to inevitably to higher tax burdens on either lower or middle income families. The main benefits of a consumption tax are three, the main potential benefits. One, that it could improve saving and capital formation. Two, that it can improve economic efficiency. And three, that it can make the tax system simpler. These aspects of consumption taxes are primarily the topics of other speakers, so I will just comment on them briefly. There are two reasons it might improve saving and capital formation. One is because it would raise the after-tax yield on investments, because it would not tax the return to investments, whereas the current income tax does tax that return. And that would, in theory, lead to higher rates of saving and ultimately more capital. Economists have studied this, have looked at how savers respond to increases in the after-tax return. I think the consensus is that it might be slightly positive, but that the effect is quite small. A second reason it might increase saving is a reason Dr. Kotlikoff has stressed, that is redistributing the tax burden from across generations. As he pointed out, and I want to stress, that effect is very dependent on the transition rules and how a new tax system would treat existing wealth. I'll come back to that, but let me just comment that we've done some studies. We've measured that the undepreciated basis of business assets, that is, the investments that have been done by businesses under which they have not yet claimed deductions for depreciation, amount to over $3 trillion today. So it is very important not only how a tax system tax futures investments, but how it deals with the investments that have been made in the past under our current system. Economic efficiency generally refers to the fact that if we don't tax all activities at the same rate, people will shift into tax-favored activities. Consumption and investment will be determined not by what best meets people's preferences or what contributes the most to the productivity of the economy, but to efforts in part to lower tax liabilities. If you look at our system, we got rid of a lot of the investment distortions in 1986, but there are two main ones left: the favorable treatment of, or the unfavorable treatment of corporate versus non-corporate forms of investment, and the unfavorable treatment generally of business investments versus household investments, particularly housing and other consumer durables. Whether a consumption tax will improve economic efficiency really depends on whether it addresses those issues. Let me just point out that those issues could also be addressed within the context, substantially within the context of an income tax. For example, many income tax systems around the world do not allow mortgage interest deductions, and many income tax systems in other countries do not have a double taxation of corporate income. They do allow, relieve the double taxation of corporate dividends. However, there are also many consumption tax plans which, for understandable political reasons, have sought to maintain the tax preferences for owner-occupied housing and maintain a mortgage interest deduction, so that the existence of tax preferences is really separate from the fact of whether we maintain an income tax or not. We can keep an income tax with fewer preferences, or we can go to a consumption tax and maintain preferences. The third issue is simplicity, and Charles McClure will talk about that more. The main simplicity advantage of a consumption tax is that you no longer need to measure income from capital. However, I do believe that the simplicity benefits have been exaggerated by many proponents. For example, many of the most difficult problems in our income tax would remain no matter what kind of tax system. I only note issues about who is an independent contractor and who is an employee. You would have to worry about that if you wanted to have a withholding system. The question of what business outlays should be deductible because they're costs of doing business, and what should be taxable to individuals because they really represent either consumption or income. For example, how do you treat the car that a business owner earns? That problem would remain under a consumption tax system as well. Let me move on to the main topic of my talk, which is the effect of consumption tax proposals on the distribution of tax burdens, and that's what George had asked me to describe. Why does that matter? Well, I think there's probably no subject on which there is wider dispersion of opinion across the political spectrum of how tax burdens should be allocated among people by income group, and it's kind of not my intention to try to sell one point of view of the other. That's really deeply embedded in value systems. But let me just comment briefly on why we should be concerned about that. And it's very well documented that income inequality in the United States has been widening over the last 20 years, and I think that's non-controversial at this point, and that fact, and is accepted in most parties. Those changes in inequality, I should say, are largely due to changes in the distribution of pre-tax income. They're not a result of changes in the tax system. Studies, for example, by the Congressional Budget Office showed that between 1977 and 1994, effective tax rates for the top 4 quintiles of the income distribution remained roughly the same. And in the bottom quintile, the effective tax rate has actually dropped substantially because of the expansion of the earned income tax credit under both the Bush and Clinton administrations. In the very highest portion of the population, the effective tax rate dropped in the 1980s, but was increased in 90 and 93 and is pretty close to where it was 20 years ago. As a kind of qualifying point, just as an aside, although I will talk about the distribution among income groups, it's obviously not the only distributional issue that we're interested in. We're also interested in whether the tax system treats people with equal incomes or equal ability to pay fairly, and how somebody who gets $30,000 of income from one source is taxed relative to someone who gets $30,000 from another source. We're also interested in how tax burdens differ among different types of families, what the adjustments are for children. We're also interested in how tax burdens vary among generations. So in looking at the income cut, I'm only looking at one cut, but nonetheless it's an important one. All right, what I'm going to do in the next 20 minutes, I believe, I'll review some of the principal tax reform proposals, and then I'll discuss some of the work that we've done at the Treasury Department in measuring the distribution of tax burdens among income groups. As I said, most of the tax reform proposals out would replace the federal income tax, the corporate and individual income taxes. Some also would replace payroll taxes with some form of consumption tax. And I want to reiterate what the point Dr. Kotlikoff said, and I think this needs to be repeated over and over again. When we talk about consumption taxes, what we mean is taxes that would exempt income from new saving from federal income tax. That's what makes something a consumption tax, and not whether it's collected from firms or from individuals. There are two ways we could exempt income from new saving. One way, which is sometimes called the cash flow or expensing method, would be to allow all purchases of assets, either by households or businesses, to be immediately deductible. That's the method that's used in retirement pension plans, where the contribution to plans, employer-provided qualified plans where the contributions are exempt, then exempt the earnings in the plans and tax the income only as it's withdrawn from consumption. A second, which under many circumstances is equivalent in present value terms, is called the prepayment method. And under that method, which actually is embodied in some of the proposals in Congress, some of the new proposals for IRA plans, what are called backloaded IRAs, you would not get a deduction for your contribution to a savings account, but you would pay no subsequent tax on either the interest income or the withdrawal from the account. And it is easy to demonstrate that with a fixed interest rate, that those two methods are equivalent in the sense that both of them leave the after-tax return from investments unchanged. The after-tax return is equal to the pre-tax return. There are three basic ways of administering consumption taxes. One is a national sales tax, which would be collected wholly from businesses. There are varieties of this, either a retail sales tax or a value-added tax. A second way is what's called the two-part tax, or the flat tax, and that's developed by Professors Hall and Rabushka at the Hoover Institution. And the flat tax was endorsed by Congressman Army and Senator Shelby, is probably the most well-known of the tax reform proposals that are under discussion. The flat tax is really basically a subtraction method value-added tax with two modifications. The first modification is that value-added tax would be imposed on every business on its sales minus purchases from other businesses. The flat tax, in addition to that, allows businesses to deduct the payment of wages to employees. At the same time, it collects tax, it imposes a tax on employees collected directly from them on their wages. So the real difference here from a value-added tax is a difference in the collection point, but not in the incidence. That is, if you think of a value-added tax including all the value-added of businesses, included the value-added of employees, under the conventional value-added tax, that tax that includes employee compensation is collected from businesses. Under the flat tax, it's deductible to businesses and collected from individuals. The advantage of collecting it from individuals is it allows some degree of progression, because under the flat tax they can then turn around and exempt a certain portion of individual wages from tax, and that would be awkward to do with a tax collected from businesses. The second difference between the conventional value-added tax and the flat tax is there are no border adjustments. Under most value-added tax proposals, exports would be exempt and imports would be taxable. Under the flat tax, because so much of the value is produced at labor, it would be difficult to disentangle exports and exempt them. All sales of businesses, whether for the domestic market or for exports, are taxable, and purchases of imports are deductible, are not included in the tax base. The third way of collecting a consumption tax is probably the most interesting, is to collect it all from individuals. And that uses the basic notion that consumption is just income less saving. And so if you collect it from all individuals, you basically can do it by having a consumption tax, having a tax which is very much like the current 1040, except you would get a deduction for all contributions to savings accounts, and really unlimited type IRA treatment, and you would be taxed on all net withdrawals of funds that are not reinvested from savings accounts. That would also, ideally, you should be taxed on the proceeds of borrowing under such a system and get a deduction for all loan repayments, whether principal or interest. And that kind of tax forms one portion of the USA tax, which was designed by Senators Nunn and Domenici. I'll go into the flat tax and the USA tax in slightly more detail. The flat tax is imposed at a 17% rate above standard exemptions, which equal $31,400 for a family of four. There's no tax on interest, dividends, and capital gains. All itemized deductions are eliminated, that is, mortgage, charitable contributions, and state and local tax deductions. And the earned income tax credit is also eliminated under the Army-Shelby proposal. The tax on businesses is also at a 17% rate on sales less purchases from other firms. Wages are deductible, and capital purchases are immediately deductible, which is what makes it a consumption tax, because there's effectively an exemption of the return to investment by allowing a deduction of capital. There are no deductions for non-pension fringe benefits. Most notably, that means health insurance premiums, which are tax exempt under our current income tax, are taxable under the flat tax proposal, but taxable at the business level. There are no deductions for payroll taxes, that is the employer contribution to Social Security and health insurance, payroll taxes. and also no deductions for state and local income and property taxes. Exports are taxable and imports deductible. Foreign source income is exempt. And a very important feature of the flat tax, which makes it score well in Larry Kotlikoff's simulations, is that there's no transition relief for old capital. So that means if you're a business and you buy $1 million of new capital the year after, the day after this a bill was passed, you would be able to deduct the entire $1 million purchase of capital immediately. But if you had purchased the asset 3 weeks before the new tax law, if you had the bad luck or poor foresight to have didn't know the law was being passed and you had made this investment program 3 weeks before, you would get no deduction of that $1 million. You would not even be able to recover it by depreciation as you can in current law. Now, my view is, and I think that rule is not sustainable, but in deference to the authors of the proposals, we've analyzed it as if that rule is in effect. The USA tax has, of non-domenici, has two separate taxes that are unintegrated: a value-added tax on businesses and a consumed income tax on individuals. And they would replace the corporate, individual, and basically replace the payroll tax through allowing tax credits to businesses and individuals. The business tax is an 11% tax on value added. There's no deduction for wages. Exports are exempt and imports are taxable. Foreign source income is exempt. There's a credit for employer payroll taxes up to the Social Security wage base. And I think most interesting, there are detailed transition rules in the proposal which allow businesses to recover most of the depreciation deductions on existing assets and most of the cost of existing inventory and cash reserves. The individual tax has a format very similar to the current federal income tax. The big difference is that net saving is deductible in calculating consumed income. None and Domenici, like Army, eliminate many deductions, but in deference to politics and social considerations, they maintain the mortgage interest deduction and the deduction for charitable contributions, and they also add a new deduction in their proposal for educational expenses. The earned income credit is retained in non-Domenici. There is a special exemption for consumption from the proceeds of state and local interests. That's to maintain the relative advantage of state and local governments in borrowing, which is eliminated under the flat tax. And there are transition rules which allow a significant amount of tax-free consumption from existing savings accounts. Let me now go to a discussion of the distributional analysis of the flat tax. And those, I've given out a number of charts which you may wish to refer to as I go through this. Since I don't have time, I won't say very much about the methodology of how we do it, other than to say we have a very detailed simulation model based both on merging of data from a large sample of individual tax returns and also from other sources such as the Survey of Consumer Finances, the census data from the Current Population Survey, and other sources in order to impute to individuals sources of income that are not reported on tax returns. Our measure of income is a very broad one. It's close to a measure of economic income, and it includes all sources of income from investment, whether people see it in their tax base or not. So we count in our measure of people's income accruals on pension funds. We count capital gains when accrued, not when realized through sales of assets. we allow an adjustment for inflation in computing the amount of capital gains. The purpose is to get a reasonable measure of people's economic well-being, which is not tied to what the current tax law is. A key element of estimating who bears the tax burden is assuming how different taxes fall on people, that is, what their price adjustments are. And we tend to, in looking at business taxes, look through the veil of the business and say, what is the economic activity which is being taxed, and what are the sources of income that are being taxed within the business? So we allocate individual income taxes very simply to those who pay them. That's pretty straightforward. We allocate payroll taxes, both the employer and employee portion, to wage earners on the presumption that that's a tax on wages, and therefore the employer as well as the employee tax equally come out of the after-tax wages of employees, one directly and the other through a decline in the wages that they would otherwise get. The corporate income tax we allocate, which is a tax on corporate profits under current law, we allocate to all recipients of income from investment. And excise taxes are borne by consumers in proportion to their consumption of taxed goods. In allocating the effects of savings deductions, we currently allocate that in proportion to receipt of capital income. That is an issue which is a difficult one because of the poor quality of data on consumption across income groups, but others who have looked at this question and allocated saving in proportion to estimates of saving from the Survey of Consumer Finances have found a distribution that's roughly similar to the one that we use. Previous work on allocating consumption by income class had looked at the Consumer Expenditure Survey, which for various reasons we think overstates the consumption relative to income of people in the bottom income classes and understates the consumption relative to income in the top income classes and makes a consumption tax look a lot more regressive than it actually is. If you turn to charts 1 and 2, that will show the present law distribution. One can see that the current tax system is moderately progressive. Effective rates range from 8% in the bottom quintile to 22% in the top quintile, and peak at 25% in the top 1%. The top quintile pays has 55% of income and pays 61% of taxes. The top 1% has 14% of income and pays 17% of taxes. This is really an amalgam of all federal taxes, and what's behind these tables are extremely progressive taxes on individual and corporate income and a regressive tax on payroll to finance Social Security. The payroll tax is regressive for two reasons. One, because it's capped at roughly $63,000 of wages, and two, because it exempts income from investment. And for both reasons, people in the highest groups pay proportionately less of the payroll tax relative to their income than others. Charts 3 to 6 show the effect of replacing the current income tax with a revenue-neutral version of the Army flat tax, which we calculate would require a rate of 20.8% to be revenue neutral. Chart 3 shows this would increase tax burdens in the bottom 4 quintiles, reduce tax burdens in the top quintile. The drops in after-tax income would fall from between 7% to 2%, and after-tax income would go up by 2% in the top quintile and 12% for the top 1%. If you look at chart 4, rather than a comparison, that just shows out a straight-out distribution of the tax burden under the flat tax. It shows that the tax burden is moderately progressive in the bottom 4 quintiles, but then turns regressive at the top. And that reflects both the absence of tax on individual source capital income and the fact that the payroll tax is maintained in actually it reflects both the lower taxes on capital income in the Army plan and also the fact that the payroll tax is still in the system with the Army flat tax. So it includes the regressivity of the payroll tax without the offsetting progressivity at the top of other taxes. Charts 5 and 6, and these are the last two, I promise you, I won't go through any more, give some indication of why the Army flat tax redistributes the tax burden the way it does. And there are really 3 things going on. One, quite obviously, is the replacement of graduated rates with a flat tax, and this is not an unusual finding and not one of the current Treasury. In 1982, we did a similar distribution of flat taxes for proposals that were being considered then before Congress, and Assistant Secretary at the time, Buck Chapman, testified on that, and the distributional pattern looked pretty different. So this is kind of a long-standing result on a flat tax. A second reason is the taxation of labor income at the business level, and that might account for what might be a kind of a questionable thing, and you might ask, why are people at the very bottom of the income distribution paying more taxes under this system when we've in fact exempted the first 31,000, or they've exempted the first 31,000 of wages from tax? And the answer is twofold. One, they're paying more tax relative to current law because they lose the benefits of the earned income tax credit while they're still paying payroll taxes. But a second reason is that because fringe benefits and payroll taxes are taxable at the business level by being made non-deductible, those taxes collected from businesses are affecting adversely people in the lowest income brackets. So that while they're not sending a check to the government, they are affected by the business tax. And chart 5 shows that the bottom 2 quintiles pay 12% of all taxes from the denial of these deductions, compared with less than 1% of the current individual income tax. A third reason is the reduction in capital income taxes, which is concentrated at the top. And I think more important, and I think this is a fundamental point about comparing a consumption tax with our current system, the change in the distribution of capital income taxes. And I think one assertion I'll make, which is borne out by the data, is that although all of us pay some taxes on interest and dividends, by and large, a very small proportion of capital income taxes today is paid by middle income and even upper middle income families. People have most of their assets in either pensions or in homes, and those are assets on which the current tax system imposes no income tax. So we have something very close to a consumption tax already in terms of tax incidence for the majority of the population. The capital income taxes that are actually paid are distributed very much toward the top end, and I think chart 6 bears that out. It shows that the very highest income families, currently they receive 16% of all taxable income. That's quite a lot of income generally for the top 1% that's concentrated in the top 1% that's subject to tax. But they receive 50% of all taxable income from capital. So current capital income taxes are very heavily distributed, and those taxes at the individual level are eliminated. What is retained is taxation of income from old capital at the business level, and because of the way the tax is structured, by denying interest deductions, the Army proposal is actually imposing a tax on earnings from from pension reserves because effectively pensions are paying a portion of that business tax. And so the current system, the current favoritism for pensions disappears under this flat tax. Well, I probably used up my time, but let me make one more point and then just conclude briefly. The one point I want to make is a consumption tax need not be regressive, and the non-Domenici plan certainly is an example of a tax, and the way they get there is by taxing consumption at the individual level and taxing them at a very steeply progressive rates, up to a rate of close to 49% on wage income when you account both the business and the individual side of the tax. 3 points to conclude. A flat tax would redistribute tax burdens substantially. A consumption tax can be made as progressive as current law, but the cost of that, and I won't go into it, but have gone into it elsewhere, is a significant complexity. And the third point is this paper considers obviously only one aspect of tax reform, and the issue really in front of us is whether these distributional concerns, whether the benefits in terms of economic growth, efficiency, and lower compliance costs are big enough to overcome these very substantial initial distributional effects, and I think that should be the focus of the debate. Finally, I want to point out and kind of echo what Secretary Baker said last night, that we shouldn't let the best be the enemy of the good. We shouldn't even let the not best be the enemy of the good, because I don't necessarily think it's the best, but in any event, we need not overturn the entire tax system. There's plenty to do in reforming the existing income tax to make it fairer and simpler, and there are also many options for introducing some element of consumption taxation in our system, as other countries do, and maintaining the income tax as a source of progressive taxation. Thank you very much.
Thank you very much, Eric. Our final paper will be presented by Dr. McClure, who will address us on the simplicity of the flat tax. Is it unique? Dr. McClure.
Well, thank you, George. It's always a pleasure to return to Rice, this time perhaps more so than usual. It's a pleasure to see my good friend and former co-author, Vice President Malcolm Gillis, to see Secretary Baker, with whom I worked at Treasury, and to appear on a panel with my friends George Zodro, Larry Kotlikoff, Eric Toder, and Rudy Penner. I want to tell you something that George could not very well have told you in his introduction, and that is that although George is a former student of mine when I taught at Rice, he also is a co-author of several papers on consumption taxation, and as I always say, he taught me everything I know about this subject, at least the part that's right. The part that's wrong, I take credit for. Much has been written and said about the simplicity of the flat tax. In fact, some advocates of the flat tax even argue that it is so simple that tax returns could be filed on a postcard. The purpose of my paper today is the limited one of determining the extent to which simplicity claimed for the flat tax is unique to that particular proposal, and to what extent simplicity could be achieved under a conventional income tax. I will briefly describe the salient features of the flat tax and contrast them with those of the income tax. Then I will describe how the salient features of the flat tax combine to create a simple system. I'll have to apologize to you because this discussion is inherently a little bit complicated, but that complexity is necessary. After all, the devil is in the details in these things. One cannot simply say we want to have a flat rate without knowing the base on which you want to levy that rate. The flat tax distinguishes between income from labor and income from business. There is no tax on capital income, that is, on dividends, interest, or capital gains. Labor income of individuals in excess of personal exemptions and a standard deduction is subject to a flat rate of tax. There are no itemized deductions for personal expenditures of individual taxpayers. The same tax rate is applied to business income as to the income of individuals. The tax on business income is levied without regard to organizational form. That is, it applies equally to the income of proprietorships, partnerships, and corporations. The two taxes, on labor income and on business income, are totally distinct. Business losses cannot be used to offset labor income, and personal exemptions and the standard deduction can be used only to offset labor income. They cannot be used to reduce tax on business income. In the parlance of us tax professionals, the flat tax consists of two schedular taxes on labor income and on business income. By comparison, the U.S. income tax on individuals is a global income tax. That is, income from business and income from capital are lumped together with labor income and subject to taxation, and business losses are offset against this aggregate income from other sources. Unlike the flat tax, there are itemized deductions for medical expenses, state and local taxes, mortgage interest related to owner-occupied housing, charitable contribution, and certain employee expenses. These reduce global income, as do personal exemptions and their standard deduction, which is an alternative to itemized deductions. The treatment of business income under the U.S. income tax is very different from that under the flat tax. Neither proprietorships nor partnerships per se pay income tax. Rather, proprietors include net business income in their tax base, and partners include their shares of income or losses of partnerships. Corporations are taxed as legal entities apart from their owners, except in the case of certain closely held corporations. Thus, corporate losses generally cannot be used to offset income from other sources. Individuals pay tax on dividends with no relief from corporate taxation of the income giving rise to the dividends. The definition of business income under the flat tax differs substantially from that under a conventional income tax. Businesses are allowed immediate write-off, which we commonly call expensing, for all legitimate business expenditures except for interest expense. By comparison, under a conventional income tax, depreciation, depletion, and amortization allowances are used to spread the cost of productive assets over the useful life of such assets. Deductions are allowed only for the cost of goods sold from inventories, not for the cost of goods added to inventories, as under the flat tax. Contrary to the situation under an income tax, interest expense is not deductible under the flat tax, and interest income is not included in the taxable income of either individuals or businesses. Similarly, neither dividends nor capital gains are subject to the flat tax. Compared to the current U.S. income tax, the flat tax is simple for several distinct reasons. I begin by discussing those elements that can be included in a conventional income tax, and then discuss those that are truly unique to a consumption-based direct tax. The flat tax would achieve substantial simplification by eliminating all itemized deductions. This benefit clearly is not unique to the flat tax. Over the years, there have been many proposals to reduce or eliminate itemized deductions under the income tax. Some would argue that this simplification is bought at too high a price, either in terms of equity or the failure to provide tax benefits for socially worthwhile expenditures. Compared to the income tax, the flat tax flips the tax treatment of interest income and expense. That is, interest is made exempt and non-deductible instead of taxable and deductible. Interest is in effect taxed through the disallowance of the interest deduction instead of explicitly when received by creditors. It is obviously vastly simpler to allow disallowance of the deduction for interest expense than it is to tax interest income. An income tax could also accommodate this flipping of the tax treatment of interest. Indeed, that is precisely what the U.S. Treasury Department recommended for business interest in its 1992 report on integration. Most of the countries of Western Europe provide relief from double taxation of income. Such partial integration is achieved by grossing up dividends to reflect the corporate tax on the corporate earnings underlying the dividends, including grossed up dividends in the taxable income of the shareholder, and then allowing a tax credit for the amount of the corporate tax imputed to the dividends. In other words, the corporate income tax is treated as a form of withholding tax as far as distributed corporate source income is concerned. Such systems are inevitably complicated. The flat tax implicitly achieves integration by exempting dividends from taxation at the shareholder level. Since corporate income and the income of shareholders are subject to the same tax rate, there is no need to go through the elaborate procedure that I just required, which is of course required if you have a graduated rate structure. Small business can achieve integration under the flat tax simply by paying salary to their owners, since that salary would be deductible at the business level and taxable at the individual level. The taxation of capital gains has traditionally been one of the most complex aspects of the income tax. Because of the preferential treatment that has ordinarily been accorded long-term gains, there is tremendous pressure to convert ordinary income to capital gains, and equally tremendous effort to prevent such conversion. And this is one of the key points I would make to advocates of preferential treatment of capital gains. The elimination of the taxation of capital income, including capital gains, under the flat tax substantially reduces this pressure. Note, however, that there would be pressure to convert non-capital income to exempt capital gains. The key to preventing this form of abuse is to be certain that business deductions cannot be taken if compensation is not taxable. The schedular nature of the flat tax has several advantages. Perhaps the most important is the fact that business losses cannot be used to shelter other income. There is thus no need to monitor the legitimacy of deductions of tax shelter losses. This simplicity, however, is not without cost. Inequities occur if real losses cannot be deducted in calculating taxable income. Moreover, the vaunted neutrality of the flat tax, which Larry Kotlikoff talked about, toward the choice between saving and investment is lost as deductions that are postponed decline in present value unless they are carried forward with interest. Since the Tax Reform Act of 1986 eliminated most of the building blocks of tax shelters, this comparative benefit of the flat tax is now relatively limited. Schedular taxation, again, is not unique to the flat tax. It could also be applied under the individual income tax. But it is true that the flat rate, the elimination of the taxation of income from capital, and flipping the tax treatment of interest makes it far easier to implement schedular taxation under the flat tax than under the income tax. The choice of a flat rate, which would be paid by all individuals and also applied to business income, contributes strongly to simplicity. Perhaps the greatest benefit of the flat rate is that it facilitates flipping of the tax treatment of interest, income, and expense. Assuming that interest rates would adjust to reflect the differences in statutory liability for tax, it should be a matter of relative indifference economically whether the tax is levied on the borrower or the lender, as long as both borrowers and lenders pay the same tax rate. If, however, borrowers and lenders are in different marginal brackets, as they would be if you did not have a flat rate, it is more difficult to justify flipping the treatment of interest. And of course, the flat rate also makes the exemption of dividends more defensible as a form of de facto integration of the business and individual income taxes. An additional benefit of a flat rate is that it would reduce the opportunities of what we call tax arbitrage, that is, the structuring of transitions intended to place taxable income in the hands of those subject to low marginal tax rates and deductions on the returns of those subject to high marginal rates. With all taxpayers subject to the same marginal rate, there would be relatively little benefit in shifting income or deductions in an attempt to minimize tax. There is again nothing unique about applying a single rate to the income of all taxpayers. This could be done under conventional income tax as easily as under the flat tax. Again, this option has a cost, the loss of progressivity, the point that Eric Toder was making. Because there would be no itemized deductions and no opportunities for tax arbitrage under the flat tax, there would be no need for an alternative minimum tax, which is one of the most complicated features of our current tax system for those who are plagued by it. But much the same is true of an income tax levied on real economic income with no exemptions and exclusions. And indeed, in our original proposals that led to the Tax Reform Act of 1986, we proposed to eliminate the alternative minimum tax because the original tax reform proposals were so comprehensive. Note, however, that the difficulties of implementing such an ideal income tax, which I'll describe momentarily, and I must confess that those complications existed in the original Treasury Department proposals. Perhaps the most conspicuous claim to fame of the flat tax is the assertion that the tax return could be filed on a postcard. My colleagues Alvin Rabushka and Bob Hall customarily carry around these postcards and hand them out as a way of showing this. Well, that's a great advantage. I think it's also true that much of this advantage could be realized under the income tax. After all, most individuals currently report no income from business and little or no income from capital. These limitations in completing 1040EZ not derived from tax treatment per se, but from the presidential checkoff, which takes 2 lines, calculation of tax-free amounts for those claimed as personal exemptions on the tax return of another person, and the earned income tax credit. So again, if you're willing to eliminate those things, probably you could put the 1040EZ on a postcard. Elimination of itemized deductions would also allow some of those who now filed Form 1040 also to use an abbreviated form of return. So again, I think that this filing on a postcard is, while an advantage, it is overstated. It's not necessarily unique to the flat tax. Some simplicity advantages of the flat tax could not be attained under the income tax. These involve the measurement of income from business and capital and are related to the treatment of business purchases, interest income and expense, and the exemption of dividends and capital gains. 2 important types of issues involving timing issues and adjustment for inflation are eliminated or rendered much less important under the flat tax. Now, I warn you, this is where you can go to sleep because it's going to get complicated for a couple of minutes, but it has to be done. The objective of an ideal system of income taxation is to tax the increase in net wealth occurring to the taxpayer during a particular time. And some of that income may actually have been used for consumption, so it may not show up as an increase in wealth at the end of the period, but at least during the period, it increases net wealth. That's what income is usually defined for tax purposes by those of us who specialize in this area. The idea is to recognize income when the real value of assets of the taxpayer increases and to allow deductions when the real value of assets falls. Now, a simplistic interpretation of this objective might leave the impression that one need only be sure that all income is subject to tax and that deductions are allowed for all legitimate costs of earning income and for nothing else. That's true, but the problem is not so simple. In order for an income tax to be fair and economically neutral, its base must accurately reflect economic income, not just some legal definition, but it has to reflect economic income. This in turn requires that income must be recognized when it is earned, that is, when net wealth increases, and that deductions be allowed when net wealth decreases. But it is difficult to know the rate at which net wealth changes. For example, when depreciable assets lose value, allowances for depreciation and amortization are rough approximations at best. Other complex timing issues involve production of assets that extends over several years, for example, large construction processes, and even the growing of timber. The accrual of liabilities over a period of years, For example, allowances for the reclamation of strip mines and the decommissioning of nuclear power plants. For inventory accounting, including which cost to capitalize instead of deducting currently, and the tax treatment of interest on bonds issued or purchased at a discount. These are among the esoterica of tax policy, but they have to be addressed. You can't just say we're going to have a 10% income tax, for example, or 15 or 20% income tax. On the other hand, all of these problems vanish under the flat tax, which is based on cash flow. That is, under the flat tax, if you receive payment, you pay tax. If you make payment, you get a deduction. You don't have to engage in the kind of complicated accrual accounting that's required to implement the income tax. And also I mentioned bonds issued at a discount. Obviously, if you're disallowing the interest deduction and not taxing interest income, that problem also goes away. During a time of inflation, an income tax that is based on values that are not adjusted for inflation is likely not to give an accurate measure of real economic income. This is perhaps most easily seen in the case that Jack Kemp discussed yesterday, the taxation of capital gains. Suppose that an asset is bought for $100 and sold for $200, producing a nominal gain of $100. If prices have risen by 100% in the interim, the real gain is only $50, not $100. If prices have doubled, there is no real gain, and if prices have risen by more than 100%, there is a real loss. Yet, our current tax system, which does not allow inflation adjustment of the basis of capital assets, imposes tax on the nominal gain of $100 regardless of the rate of inflation. Very much the same thing occurs in the more complicated cases of depreciable assets and inventories. It is fairly common in tax systems throughout the world to use ad hoc measures in an attempt to overcome the overstatement of income resulting from inflation. For example, capital gains may be taxed at preferential rates, and depreciation allowances may be accelerated. Also, LIFO accounting, last in, first out, may be used for inventory accounting, even though FIFO, first in, first out, accurately reflects the movement of inventories more accurately. None of these ad hoc measures is truly satisfactory. For example, a given level of exemption or preferential taxation of capital gains is likely to be appropriate only for a single rate of inflation and for a particular holding period. For other rates of inflation or holding periods, it is likely to be either too generous or not generous enough. Moreover, the use of ad hoc measures to compensate for inflation commonly creates opportunities for tax arbitrage and increasing complexity as the tax authorities attempt to limit such opportunities. None of these ad hoc adjustments eliminates one of the most pernicious effects of inflation, that on the cost of borrowing. Suppose that a debt is incurred when there is no inflation and the interest rate is 10%. If the inflation rate should rise to 10%, the nominal interest that is received would merely compensate the lender for the loss in the real value of principal. Yet, under our unindexed income tax, the lender would pay tax on the full 10% nominal interest payment, and the borrower would be allowed to deduct the full amount. This is clearly unfair, and this treatment can distort decisions on saving, lending, borrowing, and investment. The only truly satisfactory means of dealing with inflation is quite complicated and something that one would enter into only with some trepidation, particularly if the inflation rate is not very high. The flat rate also deals with this problem easily. Most obviously, the flip of the tax treatment of interest and the exemption of capital gains eliminates the need for inflation adjustment of these items. Because expensing is allowed for all business purchases, inflation does not have a chance to erode the value of deduction for depreciation allowances and costs of goods sold from inventory. Despite its manifest advantages, the flat tax is not without its own complexities. Many involve transactions between taxpayers and exempt individuals and institutions not conducted on an arm's length basis. Moreover, transition from the current income tax to the flat tax would inevitably be very complicated. While these issues are too complicated to be examined this morning, one potential source of complexity must be mentioned because it is so important and so obvious. Under the flat tax, deductions would exceed income for some firms that make large equity-financed investments in a given year. That is because they're allowed immediate write-off. This makes it extremely important to have a satisfactory treatment when the tax base is negative. After all, the primary economic argument for the flat tax is neutrality toward the choice between saving and consumption. This neutrality may be lost if tax losses cannot be employed currently. It clearly is not satisfactory simply to allow excess deductions to be carried forward without interest to offset income in future years, as is true under the present income tax. It would be appropriate to adjust excess deductions using a nominal rate of interest that reflects both the real value of interest and inflation, and that would be true under our existing income tax as well as the flat tax. But since we do not know the correct rate of interest to use for this purpose, this reduces one of the apparent advantages of the flat tax, namely the avoidance of timing issues and inflation adjustments. Although the most famous, the flat tax proposal is only one of several proposals for direct taxation based on consumption instead of income. The various proposals differ in several key respects, including whether they would allow itemized deductions, whether they would impose graduated rates on the taxable income of individuals, and the way they would treat debt and interest in the definition of the tax base. All would allow expensing of all business purchases. Given my prior discussion of itemized deductions and graduated rates, I need not discuss those issues further. Rather, I want to discuss how debt and interest would be treated under another pure consumption-based direct tax and under two hybrid forms of taxation, and the implications for simplicity. And in this, I will rely partly on the fact that Eric Toder has already summarized some of these. Under the consumed income tax, interest income would be taxable, and interest expense of business would be deductible, as under the current income tax. But the proceeds of borrowing would also be subject to tax, unless they were invested, and lending and repayment of debt would be deductible. Thus, only income that is consumed would be subject to tax. Under certain assumptions, the bases of the consumed income tax and the flat tax would have the same present value. After having proposed in 1988 that the government of Colombia consider a tax with a base similar to the flat tax, but with graduated rates, in 1994, Professor George Zodro and I proposed to the government of Bolivia a form of hybrid that combines features of the flat tax for individuals and the consumed tax for businesses. Since we think that this hybrid is simpler than either of the pure forms of consumption-based direct taxes, we have also since proposed it for the United States. In theory, it would be possible to combine the flat tax treatment of business with consumed income tax treatment of individuals. There is no extant proposal to do so, perhaps because this variant would be more complicated than either pure form instead of simpler. Yet, the proposal for an unlimited savings account, the USA tax, resembles such an option. It would combine a 10% subtraction method value-added tax with an income tax that allows an unlimited deduction for net saving. The flat tax would eliminate the need for the government to monitor payments of interest income to see that it is included in taxable income. That's a major source of simplification. By comparison, the consumed income tax would add a whole new dimension of record keeping and monitoring by attributing tax consequences to transactions in debt principal as well as interest. This is one of the important reasons Zodro and I favored the flat rate approach in our Colombian report. On the other hand, the flat tax has certain liabilities when applied to the taxation of business. One of the most important is that it would effectively exempt financial intermediation from liability for taxation. Imagine trying to sell that politically. Most people haven't noticed, but the flat tax would effectively eliminate the taxation of banks. In our work in Bolivia, we realized that most of the administrative difficulties of the consumed income tax approach occurred at the individual level, and it would be possible to combine flat tax treatment of individuals with consumed tax treatment of businesses to create a hybrid that is simpler than either pure form, as does not exempt the financial sector. So that is our entry in the race. The USA tax does not employ a consistent system, as do the other three approaches described earlier. As a result, it is incredibly complicated and open to abuse. After demonstrating numerous opportunities for tax arbitrage, Martin Ginsburg, one of the nation's leading tax attorneys, wrote, there are basic flaws in the unlimited savings allowance. He goes on to conclude, the legislation seems unlikely of enactment, surely unlikely of enactment in the form introduced. I certainly hope he's correct, because this thing is really a monster. In conclusion, there is no doubt that the flat tax would be much simpler than the current income tax if enacted as proposed. If, however, it were enacted with certain bells and whistles, such as itemized deductions and graduated rates, the gains in simplification would not be nearly as great. Conversely, many of the greatest gains in simplicity of the flat tax could be achieved without the wholesale overhaul of the tax base implied by adoption of the flat tax. But what could not be achieved under a conventional income tax, and the reason that George Zodro and I have favored various flat tax proposals, are the simplifications inherent in the way the flat tax would tax income from business and capital. And maybe in closing, I could just indicate the title of a paper I wrote shortly after passage of the 1986 Act, which asked the question in its subtitle, was the 1986 tax reform's finest hour or the death throes of the income tax? Did we finally prove conclusively that the income tax wouldn't work because it's so complicated?
Thank you very much, Charlie. Although there may be some question as to the extent to which the simplicity of the flat tax is unique, I think there's no doubt that we have a uniquely qualified and insightful group of experts with us today to explore the intricacies of tax reform. Let's take a very quick break, if we could, limit it to about 10 minutes or so, since we're a little bit behind schedule, and then we'll return for the discussion part of our program. We've got quite a few questions here, so I want to address those as soon as we can. Thank you. Okay, thank you very much. Let's begin the discussion section of our program with Dr. Rudolph Penner, who will offer both comments on the three papers as well as his own unique perspective on tax reform. Dr. Penner.
Thank you very much, and I would like to also thank the Baker Institute for sponsoring this excellent conference. I've been entranced with the possibility of moving to a consumption-type tax ever since I read a book by Nicholas Kaldor written in the late 50s called The Expenditure Tax. While Larry Kotlikoff made a persuasive case for tax reform based on the notion of either mitigating or reversing the effects of the disturbing fall we've had in national saving, I was an advocate of consumption taxation even before the saving rate fell. I've never really seen anything wrong with the argument Thomas Hobbes made 300 years ago that says it's fundamentally fair to tax people on the resources that they extract from the economy, as roughly measured by their consumption, rather than on the resources they contribute to the economy, as roughly measured by their income. I also believe that a very strong pragmatic case can be made for consumption taxation based on the considerations that Charlie McClure told us about. The usual economist's definition of income can only serve as an equitable and efficient and simple base for taxation if it is easy to measure capital income. And McClure provided us with a very long list of reasons that you can't do that properly.
he describes the enormous increase in simplicity that results if we don't have to administer depreciation allowances, if we don't have to differentiate capital gains from regular income or adjust balance sheets for inflation. But complexity is not the only problem. If you can't measure capital income properly, you can't treat equals equally, and that fundamental criterion of fairness must be violated. And measuring problems with capital income also have arbitrary effects on effective tax rates, and so reduce efficiency. Consequently, even if one is a firm believer in the philosophy of a pure income tax, it has to be admitted that it cannot be implemented very well, and that makes the simplicity and efficiency gains emanating from consumption taxation look even more attractive. Now, I don't want to imply by this, and Charlie pointed out some of the problems of measuring consumption. Consumption isn't easy to measure. It's bedeviled by a number of problems as well, particularly in dealing with in-kind consumption, a problem that arises, for example, in dealing with housing, the financial sector, expense allowances, and investments in land and antiques. But I think such problems are minor relative to measuring income from capital. Well, returning to Kotlikoff's main rationale for tax reform, there's been plenty of people question just how much a shift to consumption tax would actually increase national saving. Eric Toder's paper calls the issue controversial. I certainly have to admit that it is controversial because people argue about it all the time. But I have trouble understanding why, because I'm very much in Kotlikoff's camp that the effect is likely to be very large. In undergraduate economics, we learn that if you just cut the tax on the return to saving, there may be some tendency for people to run out and spend that tax cut right away, thus actually reducing saving. Now, they should be restrained in that from the fact that the reward to saving is now greater, but it cannot be denied that that propensity exists. So if you simply cut the tax rate, there's no denying that the effect of that on saving is truly controversial. But it's important to point out that that's not what we're talking about here. We're talking about a revenue-neutral tax reform in which the average taxpayer won't get a tax cut at all. So there is no ability of that person to run out and spend a tax cut. The only thing that changes for that average person is that the reward for saving is now greater. And I think that Kotlikoff makes a very important point when he says that the way that a consumption tax distributes the tax burden in itself will enhance the amount of saving you get. Because obviously, if you do this kind of tax reform, people with inherently a big propensity to save are going to get a tax cut. And given their predisposition, they're likely to save a disproportionate share of that, whereas people who spend a lot are going to get a tax increase, and they essentially have no choice but to cut their spending to pay it. So this effect, I think, would be extremely important. It's not fully revealed in Larry's model because he essentially assumes everybody's the same. They just save different amounts because they're different ages. But I suspect that there's enough difference among people that some people save more at every age, and some people are big consumers at every age. So as the tax burden is redistributed among those types of people, I think the impact will be very large. Now, there's some who have sort of rejected the whole theory that I just said we learned as undergraduates and that Larry has in his paper, and they worry that if tomorrow you implemented a consumption tax, especially the flat tax, there'd be a great spending surge as all this money currently locked in retirement accounts is released, is unlocked by tax reform. That argument implies that people somehow now end up with too much money for their taste in those accounts, maybe because they're not able to indirectly borrow against them, or because they've been irrational. I certainly don't want to rule out such things, but I find it hard to believe that such forces could be of great quantitative significance. Well, just as the Kotlikoff model probably understates the effect on saving, he implies that it understates the effects on efficiency as well, because it isn't sufficiently disaggregated to pick up all the gains from leveling the playing field for investment. It doesn't have a corporate sector and an unincorporated sector, for example. And I think when you look at the corporate sector, it is extraordinary how distorting the current corporate tax is. There's just a baffling array of effective tax rates, ranging from the highly punitive, if a particular investment throws a corporation into paying the alternative minimum tax, to the fairly lenient if an investment comes with enough credits and depreciation deductions. My firm did a study of the research and experimentation tax credit for a client, and I found it amazing how small differences between firms either said they could use the whole thing or they couldn't use it at all, with very large effects on the expected return to that kind of investment, even though there were no differences in the expected before tax rate of return. So I think allowing the market to determine where the capital goes rather than have the tax law determine that would indeed result in a very large gain in efficiency. The biggest problem, and the thing that really gives me pause in all of this, is the problem of getting there from here. I think it's obvious to me, if we started all over again, it'd be good to have a consumption-type base. But now that we start with something that's like an income tax, it's really a mixture of the two, it is very hard to transit. And I got, this may be an unfair remark, but I got the impression reading all three papers that the authors kind of thought it was optional as to whether we had big transition provision. It is true that Toder did imply that allowing some depreciation of old capital was probably a political imperative. But I think this problem is big enough that there is no way that you could have a reform without major and very important transition provisions. The authors all talked about this tax on old capital, which occurs the minute you implement a consumption tax. That tax amounts to trillions of dollars. This is no minor quantitative thing. And without relief, numerous firms would go bankrupt. The real value of equity markets would plummet. And the problem is that I don't think there's a way of solving all these problems practically. And the question to me is whether enough of these problems can be solved to make tax reform politically feasible, or whether we should throw in the towel and talk about incremental approaches that are applied over a long enough period to dull the shock. Now, incrementalism is extraordinarily painful too. It's like Chinese torture. But these are the two basic strategies of tax reform, either a radical leap with transition provisions or gradualism. All the authors have said that this consumption tax is equivalent to a tax on existing capital and wage tax. As I think Larry said, this is seldom discussed in public. It's hard to understand. Let me provide yet another explanation of why that statement is true. This tax on existing capital manifests itself in different ways depending on the nature of the reform we're talking about and whether the tax pushes up prices or whether the whole burden of the tax is shifted back to factor incomes. But if you examine the sales tax or the business part of the USA tax or the flat tax or some kind of VAT, and if I assume for the moment that this tax does not affect the price level but is shifted back to these factor incomes, what you have in essence is the firms have to pay this tax on their sales, but they no longer can deduct the cost of the capital used to produce those sales. So there aren't any longer depreciation allowances. Interest on the old debt they've had is no longer deductible. And the biggest problem, I think, involves inventories. Imagine a poor grocer buying some cases of soup in 1997, only to find that when they're sold in 1998, they face a new flat business tax. The inventory costs couldn't be deducted in 97 because they weren't part of the cost of goods sold that year. They can't be deducted in 98 because they weren't purchased in that year. So if that poor grocer was planning on a margin of 5% and now faces an unexpected tax of 20%, his or her business is in real trouble. Now, if this tax reform was correctly forecast by the grocer, there's no way they'd buy much inventory in 97, and few people would invest awaiting the pleasure of expensing such things at a 20% tax rate in the next year. So the whole thing would cause a major macroeconomic disruption, and that's something that's going to be difficult to avoid even with generous transition provisions. But there are three problems faced in having transition provisions. First and most important, they're extremely costly. And that either requires a significant increase in the marginal tax rates or a large increase in borrowing. The USA tax that I was involved in chose to resort to high marginal rates, and those rates are criticized by a great number of people. If you had to have significantly higher rates with the flat tax, it would quickly lose its appeal, as would a sales tax. Alternatively, the implied increase in borrowing to finance these transition provisions is just too large to be imaginable in my own view. Second problem is the transition provisions are inevitably bound to be highly complex. Charlie McClure mentioned the inordinate complexity of the USA tax. Much of the complexity and a considerable portion of the problems are related to transition, and it would be easy to predict if you tried to design one for the flat tax or the sales tax, you'd get in the same kind of problems. The third political problem is that different firms and individuals are affected very differently by different aspects of the transition. So it'll be very hard to get a political coalition behind any particular solution to these problems. Now, maybe the transition would be easier if you could borrow, but the numbers are truly staggering. I believe that Eric Toder, in a part of his paper he didn't read, did assume some borrowing to deal with the problem of real depreciable assets. If I have done my arithmetic correctly, the amount of borrowing just to deal with this one problem would be over $600 billion. Now, economists might make eloquent arguments as to why it's permissible to borrow to solve the problem, but I think most politicians think we had lost our minds. And I think further, the politicians' reaction has some merit. As perfect as capital markets may be, I just don't think they're perfect enough to swallow that much debt. And I also think that the creation of that much debt increases the political temptation ultimately to monetize the debt, a temptation that I think will be very strong during the retirement of the baby boom. That's not what this conference is about, but I think the problems involved in this retirement dwarf the problems we're talking about, though I do think if you can somehow figure out how to deal with the transition, tax reform can be an important component of the solution to the problem, but certainly not the only component. Well, the USA tax is the only reform proposal to consider transition issues explicitly. And I got to emphasize, it was very partial. There's another problem that hasn't been discussed by any of the papers and is very real. And that is, if you look at the balance sheet of an individual firm, it contains many things that I would call tax assets. They have accumulated losses from the past. They have tax credits they haven't used yet. All kinds of tax credits. And I think one can think of all these items as reflecting the fact that these companies have prepaid taxes under the existing system. And these net accumulated operating losses alone total over $600 billion, I believe. We didn't do anything in the USA tax to consider all of these issues. They were just too expensive to deal with. But if you ignore them entirely and just wipe them off the books, you're going to find a lot of firms with negative net worth. And again, if you look at individual industries and companies, as my firm has done for a lot of industry groups trying to decide what to say about tax reform, you're struck by how different firms are treated by various proposals. So you just can't, it's very hard to get even firms in one industry to agree on how they would approach this problem. Well, in discussing these transition problems, I have done it in the context of a world in which the whole burden of the tax was shifted backward. It didn't affect price levels. So the whole burden of this penalty would reflect itself on equity markets. People holding debt wouldn't be hurt because that would still have the same nominal value. I often run across the view that you would approach the whole problem differently if you assumed that the whole tax was shifted forward into prices. In that instance, what you would see is that the nominal value of equity wouldn't be affected at all, but the holders of debt would obviously have much less purchasing power. I think that regardless of your assumption as to which way the price effect would go, essentially the same kind of transition provisions are necessary. You need to have some deductions for inventory, for real capital, and so forth. If the prices are pushed up, the only way you can protect the investors of the equities is to undertake policies that also push the value of the equity up. In that instance, the poor debt holder is still a loser, but it is one way of approaching the problem. I hesitate, though, to go to your typical congressman and say that if you have tax reform, it's really important to be sure that the stock market goes up. That would be a hard one to sell politically. Well, as I said before, the USA tax, we devised completely arbitrary limits on what kind of deductions were allowed, and that got us into trouble in the end because working part-time on it, we did make mistakes which opened some loopholes, some of which I foresaw. Couldn't convince my colleagues that they were important, but it took a real tax lawyer like Martin Ginsburg to really exploit these things imaginatively. I think we were kind of masochistic actually trying to write a detailed proposal because the world of tax lawyers really came down on us very quickly. On the other hand, I like to think we did perform some service just indicating through some of our mistakes how hard it is to de novo create a tax system that is free of loopholes. Well, as I said, we dealt with them in the USA tax, certainly a flat tax or sales taxes. They all have to deal with these kinds of problems. There are plenty of problems, other kinds of problems. The tax return for a flat tax may fit on a postcard, but the instructions are going to cover many pages of fine print. One of the minor points that impressed me in drafting the USA tax was how many words a lawyer requires to define a dependent, for example. More seriously, as with current law, there are numerous problems in trying to differentiate business activities from personal activities that Eric and Eric mentioned. And the same problem really afflicts sales taxation, because you wouldn't want the sales tax to be on sales from business to business, so everybody would like to be a business under a sales tax. Well, let me talk a little bit about distribution tables. This isn't really a criticism of Eric Toder's paper, but I really come to hate distribution tables. Largely because I was once responsible for producing them at CBO and had to suffer while they were horribly misused by politicians and the press. I think economists realize that such tables are constructed on a bed of sand, and they treat them with appropriate disdain, but reporters and politicians treat them as though they reveal gospel truth. And these tables have an enormous, unwarranted impact on tax policy debate. The public doesn't notice the numerous qualifications you heard from Eric Toder about how much the results of these tables depend on assumptions made up often in thin air. Certainly one thing you got to know to construct a distribution table is to know who saves how much in this economy. And we've been talking a lot about saving at this conference, but our data on saving is so bad it's hard to be believed. If you look at the results of the Consumer Expenditure Survey, they're just implausible. You can't believe that people actually behave the way they respond to that table, most notably because some are huge negative savers, and you just wonder where on earth they could finance all of that excess consumption. There's a survey by the Fed that looks at balance sheets, and in our work we relied on that a lot, but some of those people save more than 100% of their income, and we know that's impossible. Now, as Eric said, Treasury has sort of thrown up its hands at all this official data, quite rightly. They've distributed saving according to capital income, but a lot of assumptions are necessary to justify that approach. So if I could just insert a small commercial here. With the budget stringency we faced in the last few years, we have really cut the budgets of our statistical agencies to the point that the quality of our numbers is really deteriorating. And when we're talking about something like tax reform, we're essentially going blind because we don't really know what goes on out there. So in the view of most economists, it would be an eminently good investment to beef up those budgets. Well, let me just talk a minute about the politics of reform and some of the other reform options that are being discussed. We economists are obviously favorably inclined toward tax reform proposals that reduce the burden on saving and investing and that would level the playing field so that we could use our scarce supply of saving more efficiently. And even economists who are philosophically opposed to consumption taxation and want to retain the income taxation, I think they would all admit that it's very important to reform the corporate tax, and some would go all the way to integrating the personal and corporate income tax system. But unfortunately, the general interest among the public in such problems is very low. I don't think people sit around the dinner table discussing the American saving rate. And the recent political campaign certainly didn't do much to educate them. And worse than that, I think, from the current the campaign, really put them off the flat tax and perhaps consumption taxation more generally when Steve Forbes couldn't articulate why his maids would have to pay an individual tax on their wages, but he wouldn't have to pay an individual tax on his interest and dividends. In the eyes of the public, I'm afraid, the corporate tax is paid by some abstract entity that has no relationship to any human being. The public is much more concerned about the complexity of the current system and what they perceive to be its unfairness. They hate the IRS, even though I doubt that many people ever have any contact with the IRS. In any case, the discussion of tax reform in Washington has shifted away from consumption taxation. Chairman Archer of the Ways and Means Committee is very anxious, naturally, to address the concerns of the public. And originally, his interest merged with an interest in moving toward consumption taxation because the chairman wrongly thought that you could administer a retail sales tax without the IRS. But given the inherent difficulty in administering sales taxes, I think the chairman now realizes that you'd almost have to have an IRS agent follow every individual around if you had a 20% sales tax. Have to follow them to millions of garage sales, for example. So as a result, the discussion of tax reform has now gone down a completely different path. There's much talk of devising systems to eliminate the tax return. And that actually appears pretty feasible for about 40 million returns that essentially report nothing but wages. You could technically do it. And it's even conceivable for everybody if we made everything rely on withholding. Withhold at wages at one rate, withhold on interest and dividends at a higher rate to give some progressivity to the system. There's a lot wrong with that kind of system. First, equals are unlikely to be treated equally. Second, you still have the problem of deciding what to do about capital gains in small business. And the thing that really worries me, if you had such a system, that I think the political dynamics would be such that it would be a lot easier to raise the rate on interest and dividend than on wages. And we could actually end up being more punitive towards saving and investing than under current law. It would be most ironic if a tax reform movement that started along a path to exempt ordinary returns to capital ultimately ended up taxing them more heavily, but stranger things have happened politically. Now, I want to emphasize that Chairman Archer is not firmly decided on any reform option. I'm just speculating wildly here. Chairman Roth of Senate Finance has not been heard from at all. He's been quietly working with members of his committee to see if there's any developing consensus to have any tax reform at all, and if so, what kind of reform. And it may well be that consumption consumption type options come back into the discussion, and they probably will, but at this minute in history, the pendulum is very much swinging against them. So I think it's important to be warned that reform may go in a very different direction than assumed at this conference. Thank you very much.
Thank you very much, Rudy. Why don't we begin by seeing if any of the panel members wish to respond very briefly to Dr. Penner's comments or to any of the other papers, and then turn to questions from the floor. Larry?
Well, just on the issue of whether this is really feasible or whether we're just kind of talking about a fantasy getting to consumption taxation, I think it's important for us to realize that all of the Western European countries, members of the European Economic Union, and Japan and Canada, they all have value-added taxes. Somehow they got to them. Somehow they survived the transition and established value-added taxes. Now, that's not to say that their whole fiscal enterprise is appropriate. I think that in general they're taxing themselves to death and that they've got some of the same problems with these pay-as-you-go systems that we have. But it's just to point out that it's actually feasible to implement consumption taxes, and that we can actually, at least be cheered by the fact that other people have actually been able to do this.
Anyone else?
I guess I just had three brief comments. I'll try to keep them brief on Rudy's remarks. One had to do with saving and the issue of whether it's controversial or not about how a consumption tax affects saving, and leaving aside the generational effect that Larry was talking about. There really are two kind of strands in the economic literature about what determines saving. One is what I learned in graduate school from Rudy and others about responses to after-tax returns. Another is a question of how people respond when money gets put in accounts for them, and whether they actually sit back and say, well, I have this money in a pension fund and therefore I'm going to save less and I'll offset it and it doesn't matter, or whether they actually save more because somebody's put money in a pension fund. And I think there is a widespread of economic evidence and view in the profession that latter effect of these, the form in which people have accounts, has a much a more important effect on national saving than the rate of return effect, and that's the aspects that's controversial. And there are enormous incentives in our current system not only to create such kinds of plans, but to create them in ways that they're available widely to rank and file workers, many of whom might not be saving or might be saving a lot less. So that's the area in which it's I think controversial. The second point was on distribution tables. I agree with Rudy that there's a great danger of those tables being misused, but I just want to state that the results on the flat tax, I believe, are very robust, and not that much has to do with the consumption tax element, that is the substitution of the economic depreciation for expensing, but a good deal of it has to do with other parts of it. And I think what's particularly important in terms of progressivity is the extent to which taxes are collected from individuals, so you can kind of individually tailor the effects, or whether they're collected from businesses, which doesn't enable you to do that. And of course the rate structure as well. The third thing, Rudy mentioned return-free systems, which is a very interesting topic. I just wanted to add to what he said that a number of countries in the world, the UK in particular, have a pay-as-you-earn system where most workers do not file tax returns. I believe there are some differences in their tax laws which make that possible. One is withholding on interest and dividends. Another is a broad flat rate ban, and a third is individual filing, that is, people file tax returns as individuals and not jointly, so that your liability doesn't depend on the income of your spouse. I've heard that even Britain is starting to re-examine its return-free system based on the increased number of small businesses and independent contractors that are starting to spring up. So I do think that's an interesting subject to discuss, but I think it's not easy to do mechanically unless we make a number of pretty profound changes in our tax law.
Yeah, I'd like to make a couple of comments about what Larry Kolikoff said, one of which is complimentary and the other which isn't particularly. The first, during the summer, I wrote a paper on entitled Tax Policy for the 21st Century, and I spent perhaps a third of that essentially taking in what Larry had said and spitting it back out about the so-called generational accounting and this fact that during the 21st century, if we don't start now to get our house in order, that there are going to be enormously high tax rates or very stringent reductions in tax benefits. This is something I think was almost criminally neglected in the recent campaign. The way I have characterized the problem is that sometime around 2010 or 2020 is going to be a very good time to be dead, because there's going to be this huge generational shootout. The thing I think Larry's point about the other countries, other advanced countries having value-added taxes and somehow they got there is just not well taken, because for example, I mean, first, all those countries also have income taxes. They didn't eliminate their income taxes when they put in the value-added taxes. And so it's not as though they pitched out something and put in something else, as we're talking about. And second of all those countries previously had some kind of sales tax, some inferior kind of sales tax. Example would be the German turnover tax, which was applied to all sales, no matter of what, and therefore you had multiple taxation each time something moved through the production distribution process. It was taxed. That's a terrible kind of tax. It was well known to be terrible. And to shift from that to a value-added tax, all you do is allow a deduction, or a credit rather, for taxes paid on your purchases. That's simple. I mean, that's a relatively simple transition. There are transition issues of how you deal with inventories, but by comparison, they're much simpler. And Canada, by comparison, had another horrible kind of sales tax, a tax on sales and manufacturers, and much of that also had this multiple taxation characteristic. And again, there were transition problems, and the VAT is not particularly popular in Canada, but that was again a case of replacing a horrible tax with a good one, and the transition problems are almost certainly a lot less important than the ones that Rudy has mentioned. I might also add that, and finally, that I hope you won't let our moderator here get away without entering into this discussion, because George is perhaps the nation's leading authority on transition rules in a shift to a consumption-based tax. I might say that in our work in Bolivia, we were blessed because they didn't have an income tax. So that was the world's best possible case, and we didn't make it. But at least there were transition issues that have been fairly easy.
Coming up in just a few minutes. But first, I think we need to turn to questions from the floor. Our first question comes from Secretary Baker and is addressed to the entire panel.
This is both a statement and a question from Secretary Baker. It really flows from the whole basic principle of the Baker Institute in being a bridge between the world of ideas and action. There is substantial support in America today for fundamental tax reform, but there is also support on the part of many interest groups for maintaining the status quo. The proponents of reform are all over the lot with respect to the exact nature the reform should take. Flat tax a la Army, Shelby, pure flat tax a la Forbes, flat tax a la Kemp yesterday, the USA tax of non Dominici, the consumption tax of Americans for fair taxation, and others. The opponents of reform are united. Anybody who has ever spent any time in Washington, D.C. knows it is easier to prevent something passing both houses of Congress and being signed by the President than it is to achieve that. Many of us remember the bloodletting that took place in order to get the 86 reforms, and they were the most far-reaching to be achieved over a period of many years and many failed efforts. Dr. Toder said that the most often used argument to defeat reform, that is fairness concerning preserving progressivity of the current system, could be dealt with, but that would make the new system, quote unquote, too complicated. So my question to the panel is, how do you get these proposals for fundamental tax reform that comes to us from the world of ideas actually implemented in the world of action?
Larry? Easy. Yeah. Well, I think that we have, this comes back to what I said at the beginning, which is that the level of the discourse is by the economists and by the public and by the people who are advocating tax reform, it's quite different. I think what we need to do is unify on something the American public can understand and see very clearly as a consumption tax, and that would be a retail sales tax. I think the objection to the retail sales tax, that it's regressive, can immediately be offset by saying, look, if you measure it relative to consumption, which is basically what people are spending their lifetime income on is consumption. So if you think about relative to your lifetime income, a consumption tax is proportional. It's not regressive, progressive, it's proportional. So you start with a tax system that's actually proportional, and then you add a demogrant, which is a fixed payment per person in society, and then you end up with something that's progressive, and so that you can structure a tax system that's got low rates, got a low rate, and has a very clear and transparent progressive element to it that everybody understands. Now, in terms of the transition rule, I think that certain things like, for example, tax-deferred assets, when they come out, they should be taxed just to provide equity for people that didn't use those vehicles in the past. But I think the transition is much simpler with this kind of a proposal, because I think a lot of the people who are just going to be sitting there delighted that they don't have to pay corporate or personal income taxes of any kind, and they're going to ignore the fact that in real terms they've just been hit with respect to their wealth, that the value of their wealth, the stock market, for example, may not decline, but if the price level goes up, then relative to how much the consumption that the value of stocks can buy, there'll be a real capital loss, but it won't be perceived as such. So I think that a lot of the concerns about transition would just evaporate if we had this very simple proposal adopted. And I think it's the one that advocates of tax reform should all rally behind and around. It's certainly the one that I think has got the best chance ultimately of winning the day down there in Washington.
I don't think that approach will work, but I don't know quite what will. I think that's a very serious and difficult question. I think my thoughts on this are probably conditioned from 1986, and Charlie McClure may have some more profound thoughts on that. But I think what takes success in reform is if one can establish one goal and never mind kind of being too religious about the means, and say this is something we want to do. And in 86 in 84 Treasury started with a very far-reaching reform, which was intended to measure income perfectly in many situations. Many of those perfections disappeared. They were perceived to be too complicated. They didn't have support of interest groups like corporate integration, indexing. A number of those provisions fell out. What did maintain from the 84 effort was the commitment to lowering marginal rates of corporations and individuals. And once that was set as the goal, and a wide enough coalition could be persuaded that that was a good goal to achieve, then it was just really a matter of kind of, well, not a simple matter, but a matter of fiddling with the other parameters in order to get there. And there were lots of twists and turns in the process. The consumption tax advocates want to eliminate taxation of income from new saving. It's not my view that that's a goal that can be achieved or should be achieved, but nonetheless, if that is the goal, one has to try to figure out how to do it in ways that maintain progressivity, that maintain revenue, so that you don't sort of drive off a lot of people for other reasons, that you try to pick what you want to achieve and then kind of figure out how that works. The interest groups are going to fight it in any case, and however you try to disguise it, people are going to know or find out they're going to be hurt. So that's my thought for what it's worth.
Let me try to make a few points here. I was struck by, in Rudy Penner's comments, how he talked about how much more neutral a reform system would be and how difficult it would be to reach such a system. Well, of course, what that is an indictment of the present system. Unfortunately, we have to play the cards that are dealt us, and I think that's what Secretary Baker is talking about, what I referred to as the tyranny of the status quo in trying to get tax reform in 1986. It's a lousy system, but there are a lot of vested interests. In '86, some of the ways that was handled was by so-called transition proposals. Well, they were no more transition proposal than I am. Basically, they were giveaways to enough influential people to buy the votes of congressmen needed to pass the thing. They made the system somewhat complicated and somewhat unfair because of the way things had to be given away to buy the votes. And I think Eric referred to what happened in '86. Basically, the strategy we tried, which succeeded, I think was the only conceivable strategy, which was to try to get enough benefit from rate reduction and from horizontal neutrality, equal treatment of equals, in order to ride over the special interests. And it ultimately did pretty much succeed despite the problems. But do we have that same kind of thing, that same kind of potential now? Well, we can't very well get an awful lot of rate reduction in a revenue neutral system because the base is in fairly decent shape. It's fairly comprehensive. So we can't do that. What can we sell? We might sell simplicity. And heavens knows there are a lot of people that would like to see a simpler system. And these are particularly, say, in the upper middle income class. But I think once they see the distribution tables coming out that they're going to take a big hit so that the highest income groups can benefit, I would guess that support is going to vanish relatively quickly. The first thing came to mind when Secretary Baker warned us that he was asking this question was what I was thinking a year ago. I had the following fear a year ago, which this week sounds a little far-fetched, but this was kind of before the Republican majority in the Congress overplayed their hand and alienated everybody. This time last year, I thought, well, life may be good. There may be a Republican majority, even a bigger Republican majority, and we may have a Republican president. That might even be somebody like Jack Kemp who supports a flat tax. Life could be good for us guys who do this for a living. And in fact, my concern was that, and I think it's well taken, given the way the Republican majority actually did things in the House, they might come in and adopt something without thinking about it enough, and that when we professionals who favored this might have been sitting and say, "Wait a minute, you got to do this seriously. You can't just pitch out 80 years of experience and put in something nobody's ever tried before without dotting all the I's and crossing all the T's." That was my fear at that time. It was somewhat misplaced. Now let me come back again and make a critical comment about Larry Kotlikoff's proposal for a retail sales tax. If you had a retail sales tax at the national level, you presumably would keep the ones at the state level. That would mean you'd have a retail sales tax in the neighborhood of 25 to 30%. This is a single-stage tax. You get one bite at the apple. If you miss it, you miss it. That's very unlike a value-added tax. A value-added tax, you kind of nibble away at the apple as things move through the production distribution process. And it's generally believed, I think, although there's no way of proving this, that while you can tolerate VAT rates fairly high, maybe as high as 20-25%, it's very hard to tolerate a one-stage sales tax that high because the incentives for evasion and the lack of the self-enforcement features of the VAT are just too significant. And it's also true that as implemented by the states, most state retail sales taxes are terrible because they don't make any real effort to eliminate tax on capital goods or other purchases by well, they make capital goods, but not purchases by business. So as a result, as much as a third or so of the tax base of the states may be these business purchases, which you don't want to tax. Well, the question is, how do you avoid taxing them? There are a variety of ways, none of them are very good. The best way is the VAT, the value-added tax. You let the business pay the tax and then get a credit for the tax against its liability on sales. That's the reason that tax is so popular throughout most of the world. Well, there's a slight problem in a federal system, and that is that it is very difficult to mesh a federal VAT with a state retail sales tax. If you'll notice, there are very few countries in the world that are federations that have working VATs. Canada does after years. I mean, they have the system after years of hand-wringing deciding whether they should do it. It turns out they have the problems we said they'd have. Germany has a federation, but there you have a federal tax and the money just is shared with the states, much easier. Brazil got it backwards. They have a state VAT, for God's sakes, and it really doesn't work, typical Brazilian approach.
Well, I think for all sorts of reasons, including tax reform, we have to figure out a way of getting the public better informed about the demographic problems that are about to face us. As Larry said in his introduction, we've got a true economic crisis coming down the pike here, and recent CBO analysis would suggest that it's coming a lot sooner than we expected. It's certainly going to be here within the life of a 30-year bond. And I think if you look at that crisis that is approaching, it does draw more attention to the importance of saving and investing in economic growth. I very much agree with Charlie. The next step is not to look at a sales tax. I just don't think you can possibly administer one that's greater than 20% for the reason he enunciated. States really do have grave problems with even 6% rates. But let me turn to the part of the glass that's half full here. I've been emphasizing a lot of transition problems. I have to say that when I first got involved with Senators Nunn and Domenici in their efforts to redesign the system, I never believed or never predicted how much interest we would attract. It was helped, of course, by the flat tax proposals, but there is, while it hasn't permeated the general public, there is an enormous amount of interest out there in reform. And one of the interesting aspects of this politically, for reasons I don't fully understand, the real tax upheavals of recent history have been generated from outside the Finance and Ways and Means Committees in the Congress. Kemp-Roth tax cuts, for example, in the early 80s, the Kemp-Bradley initiatives that ultimately led to the reform of '86 were all hatched outside the revenue-raising committees, and that's going on today. I think the real challenge here is to try and figure out how to bring the public's general concerns about simplicity, unfairness, the arbitrary IRS together with the economists' concerns about saving and investing and economic efficiency. I can't say that I have the answer to that problem at all, but that is really what we've got to work on, and if I understand that that's exactly what the sort of thing the Baker Institute is designed to work on.
Okay, thank you. We're running a little over time, but I want to take at least 4 more questions from the floor, and I'll just more or less arbitrarily assign them to each of the panel members and ask them to keep their responses brief, please. The first one goes to Dr. Penner. Please discuss the elimination of the inheritance tax as this relates to the various tax reform proposals.
That's a real tough one. First, I'll confess I don't understand the inheritance tax, how it's so easy to avoid. There are 2 totally different approaches to this. some people say reform of the inheritance tax is essential to sell consumption taxation, because otherwise you really never get Ross Perot and Warren Buffett and those guys that are really at the tippy top of the income distribution, for whom consumption taxation would be a real bonanza. On the other hand, we know that the politics of inheritance taxation is really deadly, with all the farmers and the small businessmen who want to leave their concerns to their family. And I don't want to say I know the solution to this problem, but I do think that reform of the inheritance tax is an essential component of politically selling a move to consumption taxation.
This one's for Dr. McClure. How can we successfully ever implement tax reform when the average American will never understand what the issues are? Is it possible to explain the debate in terms the average American can understand? After all, Bill Clinton is the master of this, and even he got reelected.
It's very difficult. See if this sounds familiar. When the debate was going on the what became the 86 Act, of course we watched all of the television advertisements with great interest. And it was fairly interesting that time after time after time you would see advertisements that essentially were making the argument for a consumption-based tax. That is, whether it was the inside buildup on life insurance or on capital gains on houses or whatever. They were all things that would sound to those of us on the panel like components of a consumption-based tax. People really they were appealing to the emotions of people who could understand those issues. And yet, I would guess that if we had taken the viewers to whom these ads were directed, and probably if you could have made the question comprehensible, and said, would you prefer to tax income that you receive or tax consumption? Probably a vast majority would have said it was fair to tax income, that it wasn't fair that if we'd asked that the Steve Forbeses of the world not pay tax. And so it's interesting, this kind of dichotomy in the way people thought about it. They at one level could understand some of the specifics, and yet could not at all see the forest for these trees. I guess the reason George chose me is in part because I had to warn you. This is going to get complicated. I mean, you can't. When we were at Treasury, we had hearings around the country, and some guy testified. He says, "Well, I don't think we should take any more in the tax system than God, just 10%." I say, "Yeah." I mean, I didn't say then, but I would say now, "Yeah, but the same way dealing with God, you have to say 10% of what?" And it's not so easy. I mean, even if you thought that was enough to pay the bills, 10% of what? Those 7.5 million words Jack Kemp referred to yesterday are there to answer that question. You can't just choose a rate and be done with it. You're going to need a few million of those words still.
Dr. Toder, how would using a flat rate consumption tax to replace both income and payroll taxes change its distributional effects?
I think probably would make it slightly more progressive. It would require a significantly higher rate on the flat rate tax.
And finally, to Dr. Kotlikoff, the poverty level for the elderly today is much lower than it was in 1960. Doesn't this explain much of the shift in consumption that you describe, and is this really bad news?
Well, the fact that we've reduced poverty rates among the elderly is a great achievement of the Social Security system, but in the process of doing that, we've produced a wholesale transfer from young and future Americans to contemporaneous older ones, many of which are no longer with us. I mean, a lot of that redistribution occurred in the 50s and 60s and 70s, and we can't go back after those people and ask them to help get us out of the bind that we're in. And so the real question is not one of poverty of the elderly. We've taken care of that. I don't see any scenario in which we're going to have the poverty rates of the elderly go back up. Tell you the truth, I think the real question is how much we're going to expropriate from future generations, and how bad a situation we're going to leave for them starting 20 years, 30 years from now. And are we going to have such high tax rates as a result and such high inflation to try and water down the debt that we've issued in the transition to that point, that the economy looks something like Brazil's current economy and situation? I mean, that's the really dire scenario that I see us heading toward. So consumption taxation is just one of a number of things we need to do. Medicare reform. If you come to the economics department this afternoon, you can hear me talk about Social Security privatization reform, how that would, I've got a simple scheme for doing that. Encourage you all to come. They're welcome, Church?
Certainly.
Yeah, okay.
Sewell Hall,
but-
3 o'clock.
But just to say a couple last things. Again, take Warren Buffett. If he dies and doesn't consume a penny after we have a retail sales tax and he leaves it all to his kids, and then the kids spend it, they'll pay the taxes. So you're in effect getting at you're taxing his wealth in present value. It's equivalent to a one-time tax on his wealth. So this is much more, I think, a much more severe blow to Warren Buffett than he would think ex ante, but once he really looks at it, it's really going after his wealth. That's what a consumption tax does. I think the only hope to have consumption tax reform is to keep it very simple and transparent. That's why you need to have a retail sales tax. Now, Charlie and everyone else here is right that it's hard to enforce a retail sales tax, especially when the rates are around 20, 30%, in that range. But you're going to have all these unemployed IRS agents who can go and pretend they're shoppers and go to stores, and we can throw some people in jail who don't, and give them very high penalties, who aren't collecting the sales tax, and wake everybody up to the importance of collecting the sales taxes. So I'm not so sure it's completely uncollectible. I think it should be enforceable at some level. So I'll stop there.
Very good. I think sorting through the various tax reform proposals that are currently being discussed is pretty clearly a complex endeavor, but I hope you'll agree that today's session provided a great deal of clarity and insight into the ongoing debate. And please join me in thanking the members of our panel for sharing with us their views.
We will immediately go into a summary of the conclusions of this two-day conference in just a moment. Mr. Moose, who said, he gave the analogy of being a child in school during the bipolar confrontation with the Soviet Union and having to hunker under desks in training programs at school because the threat was a nuclear war, and that now children in the inner cities are hunkering under desks because the threat to one's livelihood is really from one's neighbors and one's companions. Urban crime, drugs, violence is a real crisis in our society. We also have a crisis in values, as many participants pointed out. It demonstrates the scope of the problems our society is facing. Coherent, coordinated policies at the federal, state, and local levels are called for, with a clear trend toward bringing government closer to the people at the local, state levels. And then the whole role of civil society, the voluntary associations and the religious organizations, private organizations, and the role of the individual assuming responsibility with trends that many of our participants noted. The need for fair, just, but effective social safety net measures for the destitute and the deprived in our society. And then, of course, what we just heard, that tax policy and tax policy reform really is an essential policy tool to help create wealth and economic opportunity and jobs, and to help avoid future economic crises. We heard Jack Kemp make a basic presentation on pointing out that more revenue from a bigger economy than a smaller economy is the way to go, that economic growth is an essential goal, stating that a rate of 4% would double the American economy in 18 years. Question is whether we could ever achieve that rate of growth. That tax policy should not be used to redistribute wealth. It should be used to increase wealth, use government spending to redistribute wealth. and take away the focus from capital gains tax. He advocates completely rewriting the tax code and rewarding productive human behavior more than unproductive human behavior. He advocated a single tax, perhaps at the 25 to 28% level. He stated that the ultimate answer to poverty is to allow people to gain access to capital. Minorities should get to the point of not only gaining access to capital, but beginning to own their own businesses. Our tax code, in his view, punishes investment and rewards debt. So a lower tax rate, increased growth of the economy are essential in his mind. And again, economic growth is the key to improving life for everyone. Janet Reno basically stated there must be a balance between punishment and prevention, and called for a bipartisan and nonpartisan approach that was needed, that we all have to come together at every level of our society, that there are many pieces of the puzzle, but that she was optimistic that by a step-by-step build-up approach from the local level to the federal level, that we can really solve the problems of urban crime and violence and drugs, but a strategic plan is needed. And that the goal is to make our citizens self-sufficient and enhance the family's role. There were many themes that came back to individual responsibility and enhancing the role of the family and the importance of volunteer efforts. Is the problem too big? Not in her view. America has the strength and the power to do it. Secretary Baker last night gave a presentation that really was an umbrella to all the issues that we have been discussing over the last 2 days. And we have the speech text available for outside the room for all our audience here. He talked about revitalizing our economy, reforming government and politics, and rehabilitating our society. He advocated strongly a reform of our current tax regime. But as was indicated in the last panel, even as we investigate the possibility of replacing our current tax system, we should not allow the perfect to drive out the possible. And a streamlining of the tax code, less onerous taxation of capital, and a convergence, if not a unification of tax rates, are plainly achievable short to medium-term objectives. He called for the reduction of the federal deficit as an important goal, and to move aggressively to reduce government regulation of the job-creating private sector. In reforming government and politics, he pointed out that public confidence in government has never been lower. He referred to the deliberations in our panel on the devolution of governance, and by returning power from Washington to the states and municipalities, we achieve important objectives. He called for also a constitutional amendment imposing term limits on federal elected officials, and a constitutional amendment mandating a balanced federal budget in normal economic times, which we see is gaining much more currency even at the White House today. He also called for campaign finance reform. He talked about the values in American society and a crisis of values, and that that it is not government but individuals that must bear primary responsibility for rehabilitating American society. In conclusion, he basically said that we are witnessing, and I believe this came out in our panel discussions throughout the last 2 days, the emergence of a national consensus on the general direction we would like our society to take toward more robust and broad-based growth, toward more effective and accountable government, and toward greater emphasis upon personal responsibility. Hopefully this is the common ground upon which we can build, and hopefully this is an area that we can point to help our policymakers and decision makers move. I would now like to call on the panel chairs, who I want to commend for the great work that they did in bringing this conference together and the quality of the people and ideas that were exposed to our audience participants. First, I'd like to call on Lee Brown.
Thank you very much. I had the pleasure of chairing the panel that covered a very timely and also very important topic, urban crime and violence. In discussing the problem of crime and violence and drugs and gangs, the panel did reach some general agreements. First, that crime has gone down in many cities throughout America over the last couple of years. Yet there's still far too much crime in America, far too much for the health of America. And the problem is no longer just an urban problem. It is increasingly a problem for our suburbs and our rural areas. Second, although youth violence has gone down in recent months, that is, as measured by arrest records, young people are committing more violent crimes and doing so at a younger age. And third, fear crime is still a major problem for America. And finally, there was an agreement that to meet the public's demand that something be done about this problem, we have to explore new ways of addressing crime and violence in America. And after a very lively discussion, a number of themes emerged from the presentations and discussions that lend themselves to public policy implications with practical applications. Dr. Elliott Curry, for example, argued that there are indeed alternatives to the current way we're addressing the problem of crime and violence in America. He felt we must invest more resources in initiatives to combat child abuse and neglect. We must expand our programs for intervention into the lives of high-risk youth. We must invest in intensive programs or programs in our middle schools and high schools, programs to keep our young people on the right track. We must build on those successful programs for youth who are already in trouble and stop their penetration into the juvenile justice system. We must increase our investment in the most promising police efforts, for example, getting guns off the streets and community policing. And we must develop family support policies to accompany anti-crime policies. We must link anti-crime policy to an employment policy whereby we invest in job creation. In effect, Dr. Curry argues that we must look at crime in context of overall social economic policies and programs in America. Dr. Saunders reminded us that violence is not just a criminal justice problem, it's also a public health problem. And based on her program that deals with violence in the city of Philadelphia, she argued that violence is preventable, it is a preventable behavior, and the community must declare it as unacceptable. All segments of the society must be involved. And finally, violence prevention is a long-term proposition. Dr. Saunders argued that violence is preventable, but it must be viewed in a holistic healthcare model. Superintendent Rodriguez argued that we cannot expect the police alone to successfully address the crime problem. Rather, we must look to the family and the school for solutions. It was in that context that he felt we must invest in youth programs, not rely on short-term criminal justice measures, focus the resources of the police on crime prevention, adopt community policing as the best and most effective way of using police resources in America. He also argued that crime and violence must be viewed as a public health problem and not just the problem for the criminal justice system. Chief Charles Moose reminded us, as the ambassador said, that at one point in our history we were worried about the Russians attacking us. But today Americans are worried about crime and violence being attacked on the streets in our homes. And to address this problem, he felt we must bring about fundamental changes in all components of the criminal justice system, not just the police. Develop a holistic approach to human and community development. And to do this, we must focus on problems of health care, education, jobs, drug treatment, housing, etc. Adopt community policing with a focus on values. Focus more on crime prevention and problem solving. Chief Moose stressed the point that to reduce crime in America, we must develop healthy communities. District Attorney John Holmes argued that enforcement, prosecution, and punishment is an effective means of addressing the crime problem. He pointed out the fact that an increase in imprisonment in the state of Texas did result in a decrease in crime. He also argued that the visible presence of the police does serve as a deterrent to crime. And using his own experience as an example, he made the argument that swift and sure punishment is an important ingredient for controlling crime. In essence, Mr. Holmes forcefully argued for the role of the criminal justice system in controlling crime and violence. In effect, he would say, if you commit the crime, you must serve the time. And I think Attorney General Janet Reno summed up the sentiment of our panel when she concluded by saying, we can win the battle, but we must do so step by step, child by child, family by family, school by school, block by block, city by city. Indeed, the problem is a complex issue, and therefore the panel clearly pointed out that the plan to control crime and violence in America must be comprehensive, but place a greater emphasis on preventing crime before it occurs, while not neglecting appropriate enforcement.
Thank you very much, Lee. I'd now like to call on Bob Stein, who chaired the panel on the devolution of governance.
Thank you, Ed. The panel on devolution may have shown that the worlds of academics and the worlds of practitioners can sometimes diverge. For those of you who attended, what we know or what we think we know about devolution broke into two camps. The academics, Rashofsky, Eisinger, and Peterson, and to some extent even Ken Vickers, showed that there was expectations that the shifting of responsibility, particularly for social welfare programs, back to the state and local governments would lead to a rush to the bottom. This, drawn from economic theory, the suggestion was that states and local governments were in competition for productive capital and labor and would eschew the desire to have welfare recipients, and to do that they would in fact drop their expenditure levels. That only with the federal government could you be assured of a proper level and funding of a safety net for social welfare programs. Curiously, but not altogether surprisingly, Governor Engler and Mayor Norquist, with a little bit from Bill Hobby, our former Lieutenant Governor, were, if not surprised, even shocked. It's worth noting here that there was partisan balance in that panel. Norquist is a Democrat, Engler, of course, a Republican, and we're not quite certain where Bill Hobby is some days on the partisan preferences. That's a personal note. But both governors, practicing governor and practicing mayor at least, were absolutely assured that they were going to succeed with devolution. And there they offered the second alternative theoretical argument, and one that which is being practiced, which is that efficiency gains would lead to greater effectiveness, that state and local governments knew better how to, in fact, provide for their communities. And one other argument was that, at least in Governor Engler's case, he's already done that. It may be debated, but the simple fact of the matter is he believes it, and so do his voters. I believe Governor Engler's been reelected 3 times to the office of governor. The other observation, and one that I think got lost in this and needs to be repeated, is that there wasn't a member of that panel who didn't think that the federal government's experiment, if that's the right word, for the last 40 or 50 years with social welfare policy is an utter failure, and that it was could be no worse. I think it was Paul Peterson that said that among the 50 states, at least there was one state that could do a better job than the federal government. Of course, that remains to be seen. Something else that needs to be reminded to us is the simple fact that most of the social welfare programs we have at the federal level started at the state level. There was a Wisconsin tinge to that panel, and some of us who know history well enough to remember that things like worker compensation, child welfare laws, as well as the income tax, originated in states like Wisconsin, Minnesota, and a number of other states after the Civil War. They may want to take back this policy. There was in the Vickers paper a warning of evolution leading to a type of political warfare that we have hoped we would see the last of in the pork barrel battles of the state of the federal government in trying to, of course, provide benefits to states in order to reassure elected officials that they would retain their office. I think even Rudolph Penner suggested that in the last panel. What also came out of that panel was a series of important questions which I hope my colleagues on that panel and others at the university might consider as worthy research questions. 3 particularly come to mind. The first is, how are the states going to do a better job with welfare, particularly not so much coping with the loss of federal money, if in fact there is a loss, a point that was debated, but the real question of how to move welfare recipients off of welfare, off of unemployment, into the employment market. Here we heard from the two practitioners, the governor and mayor, that privatization of job seeking and job employment, job finding and training jobs will be the answer. The second was that this was a problem that local governments have in fact been doing a better job at, economic development. They argue, at least in the case of Norquist, that with greater flexibility, particularly in terms of using not-for-profits and private agencies, cities would in fact be able to do a better job at job training and job placement. The second question, what happens with a balanced budget amendment? Even if the contention of Governor Engler is correct, that there wasn't a cut in the money given back to the states, but really a slowing down of the rate of growth, what happens during recessions, what happens during downturns in the economy, what happens with balanced budget amendments, how will the states make up that money? And here I pose a question for my colleague, George Zodro. We've talked about a lot of tax reform, but if I recall, it was in 1916 when the federal government took the biggest bite of the tax base, and that, of course, was in the federal income tax. Will we see devolution of taxing responsibility? One argument can be made that many of the proposals for tax reforms will in fact broaden the revenues that flow back to the states. A flat tax, a consumption tax, a value-added tax might produce sufficient economic growth for states to capture some of that economic revenue base that comes from growth that would allow them to make up for what some Democrats have claimed to be a loss in revenues, and a loss that was over 60 years ago. The third question is, I think, probably the most important one. We have thought that for the last 40 years, if our welfare policies did nothing, they tended to nationalize and level the field. One of the efforts of the National Welfare Program was to assure that a child born in Mississippi by chance would not suffer in the ways he or she received benefits from the national government. And so we've seen a steady movement towards a nationalization of revenue and of spending levels across the 50 states. Will the devolution produce competition among the states, not so much a rush to the bottom, but such wide disparities that economic recessions that might rotate through the 50 states lead to incredible disparities in the resource levels and benefit levels of the 50 states? Peter Eisinger suggested this is a social and political problem. It could also be an economic problem. It's not altogether clear whether it's a good or a bad economic problem. It's a bad economic problem if children are endowed with less resources because of the misfortune of being born in a state that chooses to have lower benefit levels. But the other economic argument that might be a positive one is that in a worldwide economy, the movement of capital and labor from one region to another is a good thing, because if it doesn't move from region to region, and there isn't that wide variation in the regional economies that might come about through the differences in policies, then that capital will leave the national borders and migrate to other countries. So the question of nationalization of economic policies through the welfare devolution is well worth considering. Finally, there is this debate about the politics. I am a political scientist, and it's worthy to note here that we haven't changed our system of representation. Single-member district forms of representation, some argue, have led to this type of political system. That is to say that men and women who hold office and want to do good things, whether that's Democratic or Republican, conservative or liberal, desire to hold office. And the system of public policy that some call somewhat disparagingly pork is thought to be a vehicle by which you promote that. There's Democratic, there's Republican pork. And it is somehow thought to be connected to the re-election. Before we run pell-mell to reform our tax system or to devolve policy responsibilities, we might want to look more carefully at whether or not our system of representation is at least a contributing problem. Whether term limits is the answer or not is a debatable issue. I have to say that I am skeptical. You can take ambition out of the process, but you cannot take it out of the politician. A man or woman is told they can't run for Congress or City Council, will find another vehicle to promote their political ambition. So I only advocate a look at the political process as well as the economic and policy. Thank you.
Thank you very much, Bob. Now I want to call on George Zodro, who just finished chairing the tax policy reform panel.
Yeah, thank you, Ed. I guess my task is a little easier since the presentations are still fresh on your mind. So what I think I want to do is ask the question of what have we learned about the desirability of fundamental tax reform on our session today, and given what we've learned, how should consumption tax proponents structure their proposals to maximize their likelihood of adoption, to try to bridge the world of action and ideas in this case. In answering these questions, I will try to take off my customary hat as a consumption tax proponent and put on the hat of a more impartial observer. Well, I guess I'll leave it to you to decide how well the latter hat fits today. I'll also mention a few of the concerns that I suspect Deputy Secretary of the Treasury Larry Summers would have raised had he been able to be with us today, so you can mull these over as well. The paper presented by Professor Kotlikoff offers first a case for a consumption taxation and then strong evidence that the implementation of a consumption tax would result in significant long-run economic gains. The prospect of long-run increases of something on the order of 15% of GDP is certainly an enticing one. Moreover, as Rudy Penner noted, there really are there's an extent to which these estimates reduce or are underestimates in the sense that they don't capture the gains from an improved allocation of capital, they don't capture the gains from eliminating the differential taxation of corporate and non-corporate income. Nevertheless, to be fair, I think it has to be noted that there is far from universal agreement on the size of the gains that might be obtained from implementing a consumption tax reform. As noted by Dr. Penner, one key factor is the extent to which people would in fact save more holding income constant. The empirical evidence on this issue is mixed, although I think that the response that is assumed by Dr. Kotlikoff is really quite reasonable. But it's also not clear that the model of saving that Professor Kotlikoff uses, which assumes that individuals save solely to finance retirement consumption, explains all of saving behavior. For example, some saving is presumably for precautionary reasons, to save for a rainy day in the form of uncertainty in your income stream or uncertainty regarding the lifespan. This kind of precautionary saving is not very responsive to tax changes. Some saving is presumably for the making of gifts and bequests, but the motives for making such transfers and also the tax implications or tax effects on such transfers are not clear. Finally, individuals may not be as far-sighted as assumed in the life cycle Kotlikoff model. They may instead, as Rudy Penner suggested, some people have argued, follow simple rules of thumb that really aren't affected very much by tax factors, or they may actually be forced to save more than they otherwise would with existing pension systems, or induced to save by high-profile tax incentives like 401k plans and IRAs. Some have argued that eliminating the special tax treatment of these savings vehicles under the income tax with just the generous treatment but uniform treatment under a consumption tax might actually reduce savings. All of this is not to say that the empirical relevance of these alternatives to the Kotlikoff approach have been established. In fact, it is, I think, quite generally accepted as the current standard in economic theory. But at a minimum, it suggests that there is some disagreement in the profession as to whether the large gains predicted by the model would be realized. From a tax design standpoint, I think this means that a tax should be designed to maximize the extent to which it induces an increase in savings, since the size of the savings response is at least in some doubt. This means lower marginal rates and as big a tax hit on existing capital as possible. Unfortunately, as a number of people commented, including these features in a reform proposal causes other problems. Specifically, despite the well-known deficiencies of the Treasury-type distribution tables that were stressed by Dr. Penner, most especially the misleading picture of tax burdens provided by an annual rather than a lifetime analysis, it is a reality that any reform proposal will at least to some extent be judged in terms of such tables, and that's especially true for these plans since capital income is largely tax exempt under them, and therefore I think they suffer from an immediate perception problem. Analyses that report that fundamental reform would redistribute the tax burden in the fashion that Dr. Toder describes, I think will make reform politically infeasible, or certainly likely to, especially when economic forces outside the tax system have already contributed to significant widening of before tax differentials. I suspect, therefore, that a viable consumption tax reform proposal simply can't both fundamentally change the nature of the tax system and also be perceived as shifting the tax burden from the wealthy to the middle class in a big way. This implies that consumption tax proposals should be designed to at least approximate long-run distributional neutrality, although I really want to stress here that distributional neutrality should be defined very carefully. In particular, it should include measuring long-run burdens from something like a life cycle perspective. It should take into account the concentration of above normal returns among high-income individuals, and perhaps use conservative estimates of reform-induced efficiency and economic gains that might come about as a result of a consumption tax reform. But if such an analysis indicated that, say, a second higher marginal rate should be added to a flat rate structure, this strikes me as a reasonable accommodation. That is, approximate distributional neutrality, appropriately defined, should be viewed as a constraint on the tax reform process. Similarly, given projected deficit problems mentioned by several of our panelists that are arising in the not-so-distant future, the temptation to grease the wheels of reform by simply giving everyone a tax cut probably should be resisted. In general, it suggests that the constraints of both distributional neutrality and revenue neutrality that were imposed on the successful tax reform process in 1986 under Secretary Baker should operate in the current environment as well. The second equity issue is even more difficult. The fairness of the one-time windfall loss imposed on existing capital owners, stressed by Professor Kotlikoff, is like all equity issues open to debate. When I explain this phenomenon to my undergraduate students, they suddenly perk up. I've even seen a few sly smiles and quick converts to the cause. But when I give the same talk to a senior citizens group, the reaction is very different. And I think I have to agree with Dr. Penner that a significant accommodation in the form of transition rules would be a part of any realistic proposal, and admittedly at the cost of lower efficiency gains and increased complexity. However, I also want to stress that transitional problems should not be overstated in the sense that, in general, the group that is suffering the hit from the implementation of the consumption tax at the same time is the beneficiary of the exemption of capital income under a consumption-based tax. So what you want to ensure against in the design of your transition rules is net losses and not make a real effort to try to isolate every single individual loss and protect against it. Finally, the paper by Dr. McClure makes it very clear that although much of the simplicity advantages of a consumption tax could be obtained with reform of the income tax, some very important simplifications are unique to the consumption tax as well. Thus, enactment of such a tax could result in significant reductions in compliance and administration costs, something which is sometimes overlooked in the debate. Unfortunately, these advantages are sometimes a hard sell, especially in a world in which firms are going to have to calculate income anyway for financial accounting purposes, and where inflation is so low that inflation adjustment is less of a problem than it would be in a high inflation environment. As stressed by Dr. Penner, transition rules would, of course, add complexity to the system, thus mitigating, at least for some time period, its simplicity gains. And the same would certainly be true of international transactions between U.S. firms and firms based in other countries that would maintain their income taxes. To sum up, my personal reading of the papers presented today is that the case for fundamental tax reform is compelling, although there is certainly enough disagreement that one must design a consumption tax proposal very carefully if it's going to have any chance of being viable. The track record thus far is not very good. Proposals have been around like this in the U.S. for at least 20 years. On the other hand, the fact that so many of the current reform proposals are consumption-based clearly indicates, I think, increased interest in and awareness of the potential advantages of taxation on the basis of consumption. The fate of the current proposals is, of course, very much in doubt, but the debate, I think, is sure to be a fascinating one and likely to be the topic of at least a few more conferences like this one. Thanks very much.
Thank you very much, George. Ladies and gentlemen, thank you very much for your participation. This concludes the second annual conference of the Baker Institute.